Good morning, I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing that you need to know, it will be a busy week ahead for investors, and we're honing in on Tesla. The company will host its investor event on Wednesday, and new details may emerge about Tesla's vehicle strategy, a Cybertruck update, and its production roadmap. Many analysts believe that a new, lower-priced Tesla is a must if the company wants to grow through the end of the decade and defend its market share against its rivals. Second thing you need to know, the Oracle of Omaha has spoken. Berkshire Hathaway's CEO Warren Buffett published his annual letter to shareholders on Saturday. The company reported its highest ever annual operating profit of over $30 billion. That's a 12% increase from 2021. Berkshire used just over $2.8 billion to buy back its shares in the fourth quarter. That's down on an annual basis. Buffett used the letter to touch on some of his favorite topics, including buybacks and, quote, the economic illiterate that criticize them. At the end of 2022, Berkshire Hathaway's top 30 common stock investments had a combined market value of almost $300 trillion. The top holdings included Apple, Bank of America, and Coca-Cola. In this year's letter, Buffett pointed to a simple investment variable, time. The third thing you need to know, Pfizer is reportedly in talks to buy Seagen. This is according to the Wall Street Journal, and Seagen is a cancer drug maker that's valued at about $30 billion, and that price tag for the deal would likely be higher than that. The talks are reportedly in early stages, but a buyout is not guaranteed to happen. Seagen was in talks last year to be acquired by Merck, but the deal fell through. This move would give Pfizer a solid lineup to cancer treatments as it continues to search for revenue beyond COVID-19 related vaccine sales. Well, there's a lot happening in the week ahead, and Tesla investors are on the edge of their seats as they await Tesla's investor event. Yahoo Finance's Pras Subramanian has the details for us. Pras.
Hey, what's up, man? So, three things to watch. The main things I think are kind of long-term expansion plans. We're talking about how Musk wants to build 20 million cars by 2030, a run rate there. So we're going to need, he said, about 12 factories. So we'll hear about potentially a Mexico factory that could become, an announcement could come imminently, possibly that day. The Gen 3 platform, that cheap Tesla car. Tesla said they will reveal that platform at the meeting on Wednesday. Is it the robotaxi, the car that will kind of actually fulfill the mission of fleet operators that can actually send these cars everywhere and you can use it when you're not actually driving it? We'll see. That'll be around sub $25,000, $30,000 car. And finally, that master plan part 3, right? So that wraps in a lot of that long-term expansion plans, the cheap car, but also it's talking about fully sustainable future for Earth, right? So what does that mean? We're going to hear about possibly solar installations, a race for both commercial and residential. They paused these installations recently, so the question is why? Is it a new product offering? Why are they going to come back? What's going to happen there? And how do you store all the energy, right? Batteries. So new power walls for the home, new mega packs for commercial and utilities to use to store energy that comes from the sun. Probably hear more about that, and also minerals for batteries. How they're going to make cheaper batteries, more efficient batteries for cars, and both installations like mega packs.
So a lot in there. I guess my question is, how should we view this meeting? In other words, when Musk has come out with the master plans before, the spirit of them has been realized to some extent, even if the details have been delayed or whatever. So how should investors be making decisions based on what we're going to hear on Wednesday?
Well, I think the big thing is going to be that Gen 3 platform, that new car. Are we going to see that car? Are we going to hear about how economical it is to make, new technologies? How soon will it come out, actually? Is it going to be next year or 2 years from now? I think Gene Munster said, you take what Musk says and add 2 years to it, to when you're actually going to see it. So the question is, are investors going to believe that story? How soon is that new car going to come out and things like that?
One thing that investors, of course, continue to ask any Tesla management, and especially Elon Musk, about is how he's spending his time. And of course, the elephant in the room is where else his time is going, and that's at Twitter right now. Did you expect any Q&A session to be happening at this Investor Day where that question may come up?
There's no guidance as to whether that will actually happen, but usually they've taken questions at these events before, and I think it will come up for sure. It's such a huge topic for Elon fans and also Elon critics. I'm going to add a little wrinkle here. I was thinking about this today, and I think perhaps possible we may hear something of a succession plan, right? like who is next in line? Who are some of the lieutenants that are there that Musk relies on that potentially could be stepping in his place if he is choosing to go to SpaceX or whatever he wants to do in the future? I'm not saying it's going to happen, but it's a potential wrinkle that might be asked about, and he might give some indication as to what he's thinking about that. So maybe that will help people kind of assuage some fears about, I think it tells us the company has a pretty deep bench. They're able to perform even without Musk at 100% focus, right? So I think there's a lot of focus on Musk not being there. I think that might be misplaced. Yes, it's nice to have him there, but he is sort of everywhere. So the question is, how fully committed is he, and is it really necessary for him to be there all the time?
Well, and another way he's spending his time is with SpaceX, by the way. We should mention that too, because there was just a delay of a planned NASA launch with SpaceX. And isn't this also the first meeting where he's going to be talking about some of his other portfolio companies like SpaceX? Like SpaceX,
like Boring Company,
right.
like how the umbrella of all these companies work together. He's talked about this before with Boring Company. We're going to have this tunnel where the car is going to go through, and it's okay. Is it happening? How efficient is it to send a car through a tunnel on a rolling sort of chassis? So I think he did mention that there is a unifying theory or plan amongst all these companies. So we'll hear about that.
We will. We'll see what he has to say. It should be really interesting. Thanks, Frost. Appreciate it. Berkshire Hathaway CEO Warren Buffett published his annual letter to shareholders over the weekend. The billionaire investor shared his take on a number of topics and signaled he's not lost his confidence in the U.S. economy. Let's break it all down, get a reaction to the letter from one of Berkshire Hathaway's shareholders. Joining us now is Thomas Russo, Gardner Russo & Quinn managing member. Tom, it's great to catch up with you, as it always is, on things Buffett and otherwise. Good to see you.
Thank you. Nice to see you. Great to be here.
Buffett, as he frequently does, talked about the dangers of short-termism. Of course, his short-termism is different than everybody else's. I mean, he's talking about how the company posted a GAAP loss last year, an operating loss last year, because of poor stock performance. But a year is too short, of course, for Warren Buffett. So as an investor, how do you think about time sort of in the market here?
I think our earliest introduction to Warren was in 1982, and at the time, the shares were priced at $5 a share, maybe $7. I can't quite recall. The truth is, it's been a very patient wait. It's a 19.5% compound since they kept charts of it for the Berkshire Annual Report. It's been a very rewarding wait. It'll only work, however, if you start with the premise, which I think is at the core of Berkshire, which is the lack of agency cost. Agency cost is the tendency of your management to try to make your money their money over time, and stock option grants and all sorts of other means are used to do that. It's not so in Berkshire. There's just no other company in the world that offers as aligning of interest as does Berkshire, and is prone to as little agency cost as has been Berkshire. And so what they do generate, it has a higher compound because the owners keep all of it. And that's just unusual. So agency cost is important. The other thing is there's a principle at Berkshire which keeps it forward moving at such a steady and strong pace, and that is send the money to Omaha. All of the businesses within Berkshire excel at their competitive tasks. So they are best in class, but they don't need money all the time. And when independent, before Berkshire acquires businesses, they often stumble because they force that reinvestment decision. In Omaha, in Berkshire's hands, that money comes straight to Omaha. And that money's then able to be directed by Warren, by Charlie, by Ted, and by Todd over a very, very broad and balanced universe. They can invest in their existing businesses. They can add to portfolio positions in the stock market. They can involve themselves in specific transactions. Anyways, the deployment of capital is done by the 4 of the smartest investors in the world. And that relieves the operating head managers from the duty of deploying capital when they don't have anything pressing for their business, and they would likely make mistakes if they went outside their business to invest.
Right. Those
are the 3 things, and the balance is terribly important. And the payoff is on a year as tumultuous as this past year has been, when people who use leverage, who do different sorts of investing, suffered so deeply. Berkshire shareholders are up 4%. So Warren often says that in order to compound over time, you just need a handful of companies at any given time that are outperforming, and then the bulk of the portfolios tend to be sort of so-so. But Warren did, I think, overly penalize himself in the annual letter this year by calling his results so-so. I don't think that's a fair assessment. They've been far beyond.
I mean,
so-so.
Tom, if you bought the shares in 1982, it's been far from so-so.
Far.
And on that front, and just to pick up on something you mentioned, something that Buffett mentions in his letter, the power of compounding. For investors out there who might not be as familiar with this, and we have a definition up on the screen, it's reinvesting in assets returns to generate additional earnings over time. In other words, if you make money on that holding in the first year, you buy more of those shares, right?
Yes.
And so on and so on and so on. Talk to me about the power of compounding in your Buffett investment.
Compounding is what Einstein's been attributed as having said is the most powerful force of nature. And it means that when you retain something and earn on that retained, then the base upon which you're compounding goes up, and you have more money at work, and that compound continues, more money at work, and that's really how that advances. And one of the when I first met Mr. Buffett years ago at the meeting, he said to the investors assembled that the only thing you should really care about is taking advantage of the government's number one tax break, which is the non-taxation of unrealized gains. And so compounding is the goal. And when you say compounding on what, the way Berkshire has invested, that patient long-termism, he has held capital gains that has not been realized of $400 and some thousand dollars, $385,000 on the shares that would have been bought in the 1980s. That whole pool of money is being invested alongside of the capital that the firm has. So the compound that we enjoy as shareholders is on a much broader base than the shareholder money, because it includes the money that other advisors would have sent back to the government by virtue of high velocity trading or just an average turnover. Berkshire's turnover is extremely low, and with that we get a compound on the unrealized gain. A very, very important point.
We also heard from Warren Buffett, of course, his pushback on, hey, pleasure to meet you, Tom, on buybacks and what he thinks of that, especially calling some of those illiterate who do not believe in the buybacks or want to put more regulation or guardrails around that. What was your general take on that? And do you believe that Warren Buffett's voice will be heard perhaps within Washington, D.C. on that?
It's such an important question. I think it speaks to the lack of civility and the inability today for conversations to be based on fact and based on reality. And even Warren is human, and he's lured in on something like this, but very rarely, mind you. But in this case, I think he had a voice to say, because if you have a pool of capital, the beauty of what Berkshire's done is that they have all the money go back to Berkshire Hathaway, and then the Berkshire knows what its share price is worth. We don't necessarily know what the share price is worth, but to the precise number. But Berkshire has a sense, and when the shares are deeply trading below that intrinsic value on a per share basis, there's a great opportunity to deploy capital when Mr. Market is most fearful in shares that are familiar intimately to Warren at prices that are compelling. And so at other times it's appropriate to issue stock. This happens to be a time when things are discarded that you should probably look to buy back. And if you say to anybody that when they run a race or compete in any venture that you can only use your left hand, and you can't use your right hand when the right hand is appropriate in many instances, then I think you set yourself up for failure, or for very least, possible returns.
Well, we'll see if any more action happens on that front or not in Washington. Thomas Russo, great to catch up with you. Gardner Russo and Quinn, managing member. Appreciate your time today.
Thank you very much, Julie. Bye. Thanks,
Bye.
Brett.
Thanks. Pfizer is in discussions to acquire biotech firm Seagen in a deal that could be worth more than $30 billion. That's according to the Wall Street Journal, who says the talks are still at an early stage. There's no guarantee of a transaction, but this would make for Pfizer's fifth acquisition in under a year and increase the company's line of cancer treatment. We'll speak more about the multinational pharmaceutical giant later in the hour, but you see there a list of all of those acquisitions of various sizes.
And on to the morning brief. Salesforce is facing a defining moment in its 24-year history as growth is slowing, and analysts are worried that fundamentals will get worse before they get better. So you can read all about the latest from ticker symbol CRM in today's morning brief over at the Yahoo Finance homepage. And for a deeper dive, let's welcome in Yahoo Finance Executive Editor Brian Sazi here on set. So Brian, walk us through the elements or the core thesis behind this morning brief.
Yeah, very much a defining moment for Salesforce when they report earnings middle of the week. I believe it's Wednesday. And of course, Mark Benioff, he's going to be the one that has his name on the earnings call, that has his name on the press release here. And this is really an unprecedented activist battle. 5 of the biggest activist investors in the game, really for decades, are now attacking Salesforce. What do they want? You see some of those names on the board. Elliott, Starboard Value, and led by Jeff Smith, who got a win, Brad, as you noted this morning, over at Rogers there. Third Point, and then Jeff Ubben as well. What they essentially want is higher profit margins from Salesforce, and it is more than just laying off a next wave of workers. In January, Salesforce laid off 10% of their workforce. There is some speculation, maybe more layoffs are coming, but they want a clear roadmap to this company just operating better, not cutting costs to drive those higher profit margins. Also, realistic 2023 guidance. By right now, Salesforce does not have guidance out there for 2023. The street would like to see that. And a clear succession plan from CEO co-founder Mark Benioff. Now, this is Mark is a top CEO in the game, a big presence, a big name, but he has lost 2 co-CEOs. That was Keith Block, and he also lost Brett Taylor as well a couple months ago. I think the street wants to see who is next in line for the full-time CEO job, whereby Mark maybe is just a chairman and he doesn't have that co-CEO position.
Yeah, so we'll see what ends up happening with that. I want to broaden out the conversation. You're going to stick around, Saz, because let's talk more about the kind of impacts those activist investors could have on Salesforce. We welcome in Rishi Jaluria. He is RBC Capital Markets software equity analyst. Rishi, thanks for being here. Obviously, you just heard Saz talk about what investors want to hear now from Salesforce and from Mark Benioff. You wrote a really interesting note where you talked about the future of all of the things that have rolled up into Salesforce. And you say Slack actually might not get sold, but some of the other businesses could. Walk us through your thesis on that.
Yeah, thank you so much for having me. Look, it's no secret that Salesforce has been a serial acquirer over the past 10, 15 years. And really, in my opinion, they haven't done the best job of integrating a lot of those assets. So I actually do think a lot of their recently acquired very large assets, including Slack, Tableau, MuleSoft, I think all 3 of those are potentially on the list of assets to divest or sell off. I actually think Slack is a higher probability one because Slack has underperformed. Remember, the architect of the Slack deal was actually Brett Taylor, who's no longer co-CEO of Salesforce. He's left and he's doing his own thing. And I would argue it's not really core to what Salesforce is doing within sales, service, and marketing. So that's actually one that if I think about that, you're automatically improving margins by spinning it off. And you're eliminating what has really been a big distraction of an asset that isn't performing well. But I think Tableau has not been performing well. MuleSoft hasn't been performing well. And by no secret, all 3 of these are the biggest acquisitions in Salesforce history.
Rishi, do you anticipate anything this week from Salesforce that would clear the deck in terms of all 5 of these activists? How does Salesforce get rid of them all at once?
Yeah, I don't think there's anything they can do on earnings, right? I think that there's a lot of things that Salesforce needs to do to turn around the business. As you correctly pointed out, it's not just another round of layoffs, although that does seem to be increasingly a possibility at the company. It is turning around the culture. It is leadership changes and leadership stability. There's been a lot of executive churn over the past several months at Salesforce. I think it's more innovation and more at the product level. So really, I as much as I think they are going to guide to like a high single-digit revenue growth number and call it 24% operating margins, which would be nice expansion, I don't think that's going to be enough to clear the deck. I think it needs to have, the activists need to have board representation. They need to have more of a say. And we just see that actual turnaround start to happen at Salesforce, not just, cut heads and improve profitability.
What is Salesforce's kind of recession-resistant product that they do have, or one that they need to generate? Because if you look across the number of clients that they work with, they're looking to trim costs wherever they can right now.
Yeah, I don't think any company, by the way, in software has a recession-resistant product. But if I were to say within the stack rank of order, look, the Service Cloud piece is really important, right? Even during times where customers are looking to cut back on their costs, Service Cloud helps you retain your existing customers, right? That's what they help Salesforce customers do. So that's something that you probably don't want to really unplug or dial back on. Even the core Sales Cloud, right? No one's going to be unplugging it. It's just a matter that you might have fewer sales heads because you've seen the tech layoff numbers happening. Whereas I would say stuff like Marketing Cloud, Slack, maybe to a certain extent Tableau, Commerce Cloud, a lot of those are going to be a lot more recession prone. So if we really kind of disaggregate Salesforce into all these different businesses, Service is probably the most resilient, and then Commerce Cloud, Slack, Marketing probably on the least resilient side.
Rishi, a lot of sources that I've talked to we're familiar with this situation. They say Mark Benioff has really dug in his heels here, and he's taking these activist attacks pretty personally. To that end, does a successful resolution mean that Mark is just a chairman, and who do you see internally that can succeed him as CEO?
Yeah, look, I actually don't think necessarily the only resolution is that Benioff kind of takes a step aside and becomes the executive chairman and focuses on philanthropy and politics, although I wouldn't be surprised if that is in his future. But I don't know that there's anyone that I've seen internally at Salesforce that is ready to kind of step up to that. It might have to be an external hire to take over that mantle. Now, I'm not familiar with every single person at Salesforce, and it's definitely possible there are people who would be great to take over that mantle, but no one that I've seen so far. But again, I don't think that has to happen, right? If Benioff is willing to go along with some of the changes that the activists propose, especially if it's something that isn't draconian, like cut 20% of the workforce, and it is more about investing and integrating the products, which to me is one of the biggest things Salesforce needs to do to kind of improve their competitiveness, to improve the products, to drive cross-sell, and that all shows up in margins over time.
Why, and coming back to something that you mentioned earlier in them needing to, or perhaps kicking the tires on whether or not they should or could sell Slack, or just spin it off, rather, I should say, I think is what you said. Why would they do that? When they acquired the company for $27 billion, it's a company that's a household name, essentially, for better or for worse. But at the end of the day, it is still a company that has so much brand equity within it that Salesforce is able to benefit from longer term, even through and past this next recession.
Yeah, like from my vantage point, I think just Salesforce hasn't done much with Slack, right? The product is not integrated throughout the rest of Salesforce's products. And then Slack itself is struggling. If you look at the numbers that Slack is putting up, they're not great. And more importantly, like, you are going after Microsoft. And that's the only way Slack can succeed, is you have to invest aggressively. You have to compete against Microsoft with Microsoft Teams. And it's been hard. Microsoft Teams has been, competing incredibly well against Slack. And so if you think about all the time and effort that Salesforce would have to put into Slack to turn around the business, I think they're better off putting those efforts on the core sales, service, and marketing, and improving the products there, being more competitive, fending off the threats from upstarts like HubSpot, rather than spending all this time battling Microsoft, because that's a tough battle. And realistically, over time, I think Salesforce will have to embrace more Microsoft services, especially as the ubiquity of generative AI and ChatGPT becomes more and more front and center.
Really interesting stuff, Rishi. We'll check back in with you, of course, after we get the earnings report and as we get more from Salesforce. Appreciate your time. Rishi Jaluria, RBC Capital Markets software equity analyst, and our Brian Sassi.
Thank you.
Coming up, talks of a big move in the pharma space after a buyout by Merck collapsed last year. Reports suggest Pfizer could be swooping in for cancer drug maker Seagen. That story and all the other movers next. Welcome back. We're a few minutes till the opening bell. Let's get to some movers we're watching. Tegna is one of them. Look at the plunge in those shares, down 24% as the FCC orders a hearing on Standard General's bid to purchase the company, delayed with concern that the transaction may trigger price increases for consumers. So basically, the FCC was considering whether to approve this deal. And now they've said that they are holding off on it. They're asking for closer review, according to the statement, to ensure that this transaction does not anti-competitively raise prices or put jobs in local newsrooms at risk. This is an owner of 64 television stations.
Yeah, and we got all the elements leading up to this decision for months now. You had the previous House Speaker Nancy Pelosi weighing in on the deal. This was last autumn, basically, where in a letter they had also warned about the potential impact on some of everything from the consumer prices that you're paying, the jobs as well that would be impacted by this, because there typically would be some type of, or at least they had seen in the past, the propensity for there to be a sweeping layoff that would take place after this deal was consummated as well. So they wanted to safeguard against that. But they had described this, and within Washington, D.C., described this as piping in news produced in Washington to fill time on local newscasts as a public interest benefit. And some of the regulators were pushing back against that as well swiftly there. So you heard about that from several lawmakers last year in Q3.
Yeah, and the unions have been against this deal as well. They have pointed to other hedge fund purchases of news outlets and pointed to negative impacts from that. There was some really interesting commentary from the analysts over at Benchmark Co. Saying the FCC is effectively killing the transaction. And they say, if you read between the lines of this FCC release, the FCC both believes that something illicit is going on with the deal structure and that Standard General effectively lied in their responses, bringing up the non-negotiable topic of candor. Now, again, that's the words of Benchmark, not mine, but still, that's pretty dramatic to say, it does sound, analysts are effectively saying this deal is not happening.
Right.
And that's what the stock price is saying too.
Exactly. And that's speaking volumes here this morning as well. So continuing to watch that one as we get closer to the start of today's trading activity.
Yeah. And speaking of the start of today's trading activity, stocks obviously have been sort of wavering as of late, looking to attempt a rebound in today's session as we look ahead to the week. When we do have some economic data coming on tap, we got pending home sales coming up at 10 a.m. We do not have the jobs report this week. Rather, it's not on the first Friday this time. It's on March 10th. So that's something that investors are looking ahead a little further to. You see S&P Global, our friend Doug Peterson ringing the opening bell here on this Monday morning here as stocks are attempting a comeback from the declines that we have been seeing as of late. So we'll see if they can hold on to them. We were talking about at the end of last week sort of what has led the way downward in this latest downdraft that we have seen for stocks. And it's sort of a mixed bag of groups, but communication services on that list of groups that has been weak, among others. I think that real estate was on that list as well, as we have seen rates move up, a lot of money pour into bonds, and at least some of that money having come out of stocks. But that's changing today. We'll see if it lasts beyond today, Brad. But we're seeing a little bit of a bump today.
Yeah, we will see if this holds up. Right now, we are up by about 0.6% on the Dow Jones Industrial Average. And since you mentioned last week's activity, wanted to give our viewers a look at exactly how we've been trading coming into today's trading activity and the start of the session. We are down over the past 7 days by about 3.2%. Now that takes us past last week and even the week before just by a blippity blip. So ultimately here, as you're taking a look at that chart, keep that in context here of where we have been moving over these recent 7 sessions or so. Also, over those past 7 sessions, you've seen the Nasdaq Composite move lower by about 4.5%. Here today, though, out of the gate, some strong activity. We're up triple digits, 125 points on the Nasdaq. That equates to about 1.1%. Also on the S&P 500, you're seeing that higher in the green by about 0.8%, rounding out that hat trick, the trifecta, the triple double, whatever you want to call it up. However, the past 7 days down 3.5%. Let's also take a look at the sector activity here as we begin a new trading week here. And this is the final couple trading sessions of February here. And so as we're taking a look at the move out of the gate this morning, we're seeing green across the screen. It's looking pretty good here, folks. Taking a look at XLI, those industrials leading the charge, up by about 1.3%. Right behind it, you've got real estate and consumer discretionary here. Energy is the worst of the best. However, it's still in the green by about 0.1%. And lastly, we'll round out with a look of the Nasdaq 100. Not too much red to be seen there, Julie, here, but taking a look at some of those mega cap tech stocks, you've got Apple up by about 1%. Microsoft about the same there on a percentage basis. And then additionally, Tesla, of course, we were talking about that big investor event that's taking place this week, starts off the week up by about 2.7%.
Yeah, interesting. I guess there's some optimism ahead of that event.
Maybe a Cybertruck.
The master plan.
Yes.
The master plan to rule us all. Let's talk about some other movers that we're watching. Union Pacific CEO Lance Fritz plans to step down later this year following pressure from a key shareholder. Those shares today are up by 11%. This is a really interesting unfolding situation here that we have been watching. Soroban Capital Partners is the company that owns a stake in this company that's worth about $1.6 billion. And according to the company, they've been engaging with this fund going back to 2017. What's also interesting is the company came out and said, we actually hired somebody last year to look at succession planning and figure out the next CEO. But we didn't know that until now when this hedge fund started kind of poking at them. Yeah,
they've got about $10 billion in assets under management. And according to what they're looking to do here, as you were kind of laying out the specs that they're looking to change over, especially at the CEO level, and Lance Fritz, who we've had on Yahoo Finance time after time again, he's been generous with his time in everything from some of the supply chain issues that Union Pacific was trying to move through and help a lot of its own partners and customers move through as well, to even some of the looting that was taking place in the rail lines in the West Coast last year, and really taking time to describe all of that to us. It's been a strenuous time over these past kind of 12 months here. And so Soroban wanting Jim Vena, who is, and I think I have that pronunciation correct, formerly Union Pacific's chief operating officer, wants them to become CEO of the firm now.
Yes, and Bank of America, by the way, out with a note today, upgrading the price target to $241 a share, saying that this could potentially be a further catalyst for the stock to move higher. The analyst over there, Ken Hexter, also pointing out that the operating efficiency ratio, which is really the important metric by which most of the railroads are measured, that it's not been doing great in the last couple of years. 60% is sort of the dividing line here, and that's a line that Union Pacific had said it was aiming at to remain above for more sustainable period. Really from prior to 2018, it was there. It was above 60% very consistently, and then had fallen below that and is just peaking back above it. So that's the number that I imagine Soroban and investors are going to be watching, whoever ends up leading the company.
Yeah, that's true. We'll be keeping an eye on the share price action here on the day, but still holding up quite frankly to the upside, as you were seeing there on the screen a moment ago. Let's also take a look at Pfizer here this morning in early stage talks to acquire biotech company Seagen. This is according to the Wall Street Journal, and this comes after Seagen and Merck, they failed to reach an agreement last year. Joining us here to discuss, we've got Yahoo Finance's Anjali Kamlani. Anj, what do we know about this one so far, and especially considering how many different companies have been looking at Seagen for a potential acquisition?
Well, it's interesting that you talk about Merck. Of course, we know that deal fell through, but they already have a partnership with Seagen with one of Seagen's products. They are looking at regulatory approval of that right now. They got fast track designation of another. So really a lot going on with Seagen's pipeline, which is why it's of interest to all these companies. It's a late stage company, does have a couple of products that are bringing in some revenue, does have fast track approval. So it's a really interesting acquisition target for anyone who's doing cancer like Pfizer. We know that Pfizer, of course, has its own cancer portfolio and has indicated in the past, including in interviews with Yahoo Finance, that it is going to be going after external targets to boost its pipeline. Already, we know it's facing a patent cliff with several of its products and has already indicated that they have about 15 or so other products in the pipeline that they expect to fill that shortfall of revenue in the coming years. So all told, interesting to see how it goes. The one interesting part of this, though, is that when Merck was pursuing Seagen, that rumored target was going to be about $40 billion for that acquisition. Now we're looking at Pfizer with more than 30, but it's interesting that 30 billion is where the value's at right now, and that's sort of where the starting point is. So going to be interesting to see how that goes through, whether or not there are any antitrust issues. We know that, of course, pharma is a very big piece of interest for regulatory authorities these days, so will be an interesting deal to watch.
Yeah, I mean, it seems like there's been a lot of scrutiny on antitrust from all kinds of different industries, right? Pfizer also has been super acquisitive. And so this would just be the latest, although it would be larger than some of its other recent acquisitions as the company tries to sort of push past COVID. How do we sort of put this one in context, given how acquisitive it has been?
Well, it definitely is of the larger ones. We know that they've had a couple others like the blood therapeutics as well as Biohaven. Those have been smaller in the 5 to 10 billion range. So 30 would be one of the bigger ones of its recent acquisitions. Also, it's pretty cash heavy. We know, of course, the COVID vaccine has really been a boost for the bottom line for the company. They're sitting on upwards of, I think, 20 or so in cash. So it's a lot going on right now when it comes to what the company could be doing. They also do have an internal R&D structure, but they have indicated that there are certain ones that they don't necessarily want to make the investments into. So rather than building up the internal infrastructure, they're looking externally for some of these. So it's going to be interesting to see if they keep on track with these larger type acquisitions or go back to what they were doing with the 5 to 10 billion.
All right, Yahoo Finance's own Anjali Kamlani, thanks for tracking all the moving parts on this deal and breaking it down for us in the healthcare segment. Appreciate it. You guys, coming up, is the return of volatility something for investors to start positioning for? We break it down with Yahoo Finance's Jared Blickery along with all the market action. That's next. Welcome back to Yahoo Finance Live this morning, everyone. Major averages in the green across the board for the Dow, the S&P 500, and the Nasdaq. This as investors braced for increased market volatility after last week's weak performance. Let's get to Jared Blickery at the Wi-Fi Interactive this morning. Jared.
Yes, I thought we'd take a look at volatility, specifically the VIX this morning, but we're going to take a look at some other measures as well. VIX measures options volatility that's implied in the S&P 500 by measuring those options contracts. Now, VIX, this is going back 2 years, and what I want people to take away, this is a mean reverting asset here. When we get these big spikes up, well, we expect them to come back down to a lower level, and we get a little bit of a nesting down here, as we often do with a rounded bottom. We expect another spike up. And over the last 2 years, you can see indeed that when we get down to lower levels, we have tended to spike up. But over the last year, and let's consider that last year was that worst year for 60-40 and forever, and all that volatility, we kind of had a new norm. And right here, right about a few weeks ago, we did poke down into those levels that we were seeing a few years ago. So maybe volatility is returning to this prior regime where we have a more stable market that would be conducive to a bull market. But let's not get ahead of ourselves just yet, because we want to talk about bond market volatility as well. This is the ICE of a move index. This is also going back 2 years. And with all the talk about the hawkish Fed last year and that huge pivot, 75 basis points at a clip 4 times in a row, that increased bond market volatility to a large degree. And in fact, if we take a look at a 5-year chart, this will capture the pandemic highs as well. We had as much volatility as we did in the throes of the pandemic several years ago. So instructive to see this playing out, because when we have volatility in the bond market, that shrinks the amount of leverage available in the system to finance risk trades. So equity positions get hurt as well. Now, I want to show one final chart here. This is showing VIX average daily call options volume. So you can play volatility by buying call options on the VIX, and this is a strategy that is seeing the highest levels since, guess what, way back in the throes of those pandemic lows that we saw a few years ago. So all of this put together, I said maybe we're falling into a lower volatility regime. Well, this suggests we may have one final upsurge yet to manifest itself. So we'll be on the lookout for that, guys.
Yeah, we will. Certainly people are preparing for it.
Yes.
Right? Betting on it. We'll see.
They're buying the protection right there.
Yeah, we'll see what ends up happening. Thanks, Jared. Appreciate it. Coming up, future tech. Will the big push for AI technologies benefit data center providers like Equinix? We're going to ask the group's CFO next. Data center provider Equinix has established a track record of revenue growth using its platform to provide and connect digital infrastructure from companies like Google Cloud, Zoom, and Oracle. It offers them server space at its data centers as well as support services like IT installation, server monitoring, and remote management. Market intelligence from IDC estimates spending on digital technology by organizations will grow 8 times faster than the broader economy. For more on the growth outlook for Equinix, let's get to its Chief Financial Officer, Keith Taylor. Keith, welcome. We had this whole data conversation in the break, and it occurred to me, I didn't even ask if it's Equinix or Equinix.
Yeah, Equinix.
Equinix.
There you go.
So there you go. So I said that one wrong. So talk to us about, there's been such a big conversation recently about artificial intelligence. And as we know, that requires a lot of cloud computing, data center computing power. What's the potential around that opportunity for you guys?
Well, first and foremost, the data center itself, it's an ecosystem, a set of ecosystems. And AI to us is just another ecosystem. For us, think of us as the on and off ramp to both the internet and to the cloud. And AI is just another aspect of that. And for us, they're going to need capacity, they need proximity to their data, they need storage, they need distribution, and all of those work very well inside our environment.
What are you hearing from your customers in the element of security on top of the data center as well right now? This is something that's come up in multiple earnings calls for some of your competitors as well.
Well, I think security is critically important for a number of reasons. One, to protect all the sensitive things that are in the marketplace. But for us, we think about it as physical security. There's also cybersecurity,
right.
but there's 5 elements of security before you can even get to your cage inside our data centers. And as a result, we're highly concerned about security, but we really focus on the physical. And then there's an aspect of basically the virtual, which is the cyber side. And it's the combination of those two that I think make us a sort of very credible place to locate your infrastructure.
I mean, we have had situations in the past year where there have been attacks on utilities, power plants, for example. So when I think of physical threats, that's an example that I think of. Is that something that, have you experienced attempts on data centers, and how do you keep people from getting in?
Well, again, it's a very highly protected asset, no surprise. And they tend to be in sort of nondescript industrial locations, generally. But overall, the internet is inherently very redundant. And so even if there was a physical attack, the internet finds a way to reroute itself. And it's, for us, I wouldn't say it's highly important for all of our customers, but it's not. What's more important is the sort of the collection of the customers that sort of operate inside our environment. It's that ecosystem that's much more important to us, and I think what the customers are looking for.
During the height of some of the energy costs that we had seen last year, there was a big impact to data center companies and businesses. Has that started to abate a little bit, and how has that perhaps increased some of your own margins, especially at a time where there is a shift towards more sustainable energy uses as well?
Yes, it's an absolutely great question. We're in all 3 regions of the world, but the one that we worry the most about as it relates to energy is Europe. And our costs went up substantially. And one of the commitments that we made to our customers is, one, we're very sophisticated in the hedges we put in place and how we procure power in advance. But we're passing that cost on to our customers. And the deal that we effectively had with our customers is we will pass it on to you with no margin. So again, sophisticated hedging programs, number one, and then driving down our costs that lower than the customer could get themselves, lower than our competitors, and lower than the prevailing market, because we go in and buy on a periodic basis. But just to give you a sense, that added 400 to 500 basis points of growth to our 2023 guide. But it also impacted our margins because we agreed that we weren't going to take margin on it. So revenues are up. On an unadjusted basis, though, our revenues are still going to grow 9 to 10%. With power, it's 14 to 15%.
Have you seen any pushback on that pricing? I mean, obviously, this is a time where we're talking about a company almost every day in the enterprise software space, some of them in the data, that rely on data centers that are cutting costs. Are you seeing any slowdown in growth or any of your customers cutting back?
We're not seeing a slowdown in growth, but absolutely it's going to impact businesses. Their costs are going up, and we all feel it, whether it's Equinix proper or whether it's our customers. But it's the combination of us being more sophisticated and actually procuring at a price point than they could not otherwise get it at. So yes, the customer doesn't like the fact that prices are going up, but when you're with Equinix, at least you're not paying the same rate as you'd be paying somewhere else.
We've heard a lot of talk about what artificial intelligence would look like in data centers and in clouds. For Equinix and where some of your customers are looking for those solutions, where does that kind of sit within the set of solutions that you offer on the data center business side?
Well, I think AI is going to be another ecosystem. It's still developing, as you know, Brad. And I think over time, as we continue to see how the market evolves, that's going to be a great opportunity for us. Because again, AI is not just about one or two companies. It's really about a collection of assets and an infrastructure that will have to be proximate to a number of other locations and other providers. And our sense is that it is evolving. It's a bit early yet, but we see it as another super opportunity, no different than the internet itself, or telecom, or financial services, or even cloud. And again, we have a lot of cloud providers. Again, 3,000 cloud and IT services companies inside our assets. That's an ecosystem, and AI will be a component of one of those ecosystems as well.
Keith, finally, we talked about energy costs a little bit, and data centers are sort of one of the quieter or less well-known consumers of energy. What are you guys doing about making them more efficient? Because that's, I know, been a big push.
Julie, efficiency for us is highly important, not only for how we consume and how we incur our costs, but also ultimately what we pass on to our customers. But our focus is trying to drive down efficiency, and we measure it by power usage effectiveness, PUE. And so the lower that you get that, the more efficient you're running. And our customers mandate certain PUE objectives. So it's a combination of driving down the efficiency to be most efficient, and again, something really important to both the customer and ourselves, but also having sustainability in mind. And again, our focus on renewability and using less water, less energy, electric vehicles, all of that is a sort of a collection of what we need to do for our customers, and it makes a huge difference.
All right, Keith. Thanks for coming in. Good to meet you in
Thank you for
person.
having me.
Keith Taylor, Equinix Chief Financial Officer. Appreciate your time this morning. Thank you.
Thank you.
Coming up, big names in retail post earnings this week, what the latest from Target, Costco, and more could mean for where the market is going. And we've got
Warren Buffett's annual Berkshire Hathaway shareholder letter is set to be released on Saturday. Now, the letter digs into Buffett's top holdings, how his investment strategy has played out over the last year, and what could come next for the firm. Yahoo Finance's Josh Schaefer is here with a breakdown of those top holdings. Josh, on over to you.
So like most investors, Warren Buffett's diversified portfolio has consolidated over time. As of December 31st, 2022, Berkshire Hathaway's top 5 holdings made up about 75% of the company's entire portfolio value. Apple is Berkshire's top holding, accounting for about 40% of the company's portfolio. That's about 4 times the size of the next closest company, Bank of America, which accounts for just more than 11% of Berkshire's holdings. Up next is Chevron. The oil giant accounts for just shy of 10% of Berkshire's holdings, while Coca-Cola, one of Buffett's most famous investments, particularly given his insistence on always sipping that soft drink, represents 8.5% of the portfolio. And American Express, a longtime holding of Buffett, rounds out the top 5, accounting for 7.5% of Berkshire's holdings in this.
So I guess the question is, when the Oracle of Omaha bought these, how have they done? How have these stocks done since you've bought them?
Right, so let's take a look at Apple first. And you would think buying Apple in 2016 might have actually been late, right? I mean, the iPhone came out right around here, and you see a big jump there. But really, when you take a look at where they bought it in 2016, let me just get my pen going here. They bought it in 2016 here. And then it took a big jump after that. And then they've sort of benefited from Apple's growth in iPhone services and sort of the services and cloud as a whole. Then when you take a look at Bank of America, they bought Bank of America, if we pull up a 10-year chart, they bought Bank of America in the early part here, back actually in 2011. So they bought Bank of America down here. You can see the ride that Bank of America went on after that. So in some senses there, it was about buying Bank of America at the right price, basically buying almost the bottom of Bank of America, even lower than the great financial crisis. And then I want to round it out with Coca-Cola. This is a stock that Warren Buffett has owned for a long time. Going back to 1988, that's around the time that Powerade came out. Coca-Cola's Gatorade equivalent, right? And sort of you can see how they benefited from the long rise of Coke when you take a look at a Coke Max chart. you can see that stock all time is up over 4,000%. And you can really see the big jump here that happened after Berkshire bought in those early days. Because again, guys, for Warren Buffett, it's about holding on for a long time and benefiting from those product innovations. Coke Zero didn't even come out until about, I think it was 2005 or 2006. So think about how much that company's changed since '88. Over 30 years later, they're still along for the ride.
And there's a reason why he's known as such a legend, right?
We've got a big week ahead for retail juggernauts. Target's fourth quarter earnings are on deck ahead of the market open tomorrow. Costco is going to follow later in the week. Analysts are eager for the data as an indicator of how consumer spending is tracking and what those trends could mean for interest rates later this year.
Yeah. Coming up, how Washington's plans for credit card late fees could force banks to change the way that they do business. We'll get the latest from the Capitol. That's next. Welcome back to Yahoo Finance This Morning. I'm Brad Smith alongside Julie Hyman. Let's take a quick check of the markets here as we hit the top of the 10 a.m. hour. And taking a look at the Dow Jones Industrial Average, you got some positive candlestick activity adding on to the gains that we had already seen out of the open. As of right now, the Dow up by about 0.9% here. 280 points is what that equates to. Nasdaq Composite also in the green. That up by about 131 points right now. 1.2% in positive territory, 1.1-ish, 2%, however you're rounding that off at home. Also some more solid candlestick moves there that you're seeing on the S&P 500. That's up nearly a full percent here. Again, backing that out for the past 5 days here. Still net lower, but still some good activity to start off the trading week here. And then additionally, taking a look at some of the sector activity just to see where things are stabilizing. We are still in the green across the board. Take a look at technology. That's up by about 1.1%. It's not the biggest gainer. That would begin to XLRE on the day. Real estate, you're seeing that higher by about 1.5%, which is fitting for some of the economic news that we're about to break down for you here. However, we've got one lone laggard this morning. Flat, just barely, well, now to the upside. It was lagging, really messing up my story there. Anyway, XLE. it's flippity flop.
And I see real estate is in the top spot here today. We just got pending home sales numbers just a second ago, and pending home sales up 8.1%. It's the biggest gain since June of 2020 in that measure. So again, an 8.1% gain in pending home sales in the month of January. That's much better than the 1% that economists were estimating. The month of December being revised down to a month-over-month gain of 1.1%, but still seeing a little tiny bit of momentum creeping back into the housing market. Year over year, the non-seasonally adjusted number falling by 22.4%, but nonetheless, a little bit more encouraging here. And the National Association of Realtors noting that pending sales is up month over month in all 4 U.S. regions, even though it's down from a year ago. It is up month over month, and we have gotten a little bit of commentary from some analysts that perhaps there's been a bottoming in the housing market of some extent. We're going to talk about that a little in just a few moments. But we are watching all of these housing numbers very, very carefully because of the reacceleration that we have seen in mortgage rates, right? And the effect that that could potentially have on the market. Well, speaking of mortgage rates, of course, they're tied to benchmark interest rates. Investors are looking closely at Fed comments this week for views on the latest economic data and the policy outlook following last Friday's surprisingly strong inflation report, that PCE report. Here to discuss this and more is Gibson Smith, Smith's Capital Investors founder and chief investment officer. Gibson, thank you for being here. I just mentioned the pending home sales that we got. We got PCE on Friday, showing some heat is still there in inflation. What does all of this mean for the interest rate outlook in your view?
Well, it's been just a fascinating year to date, where we've seen rates rally and stocks rally really hard in January and then completely reverse course in February. And I think what's playing out here is the market is and was getting in front of the Fed in this view that their aggressiveness over the last 12, 13 months would ultimately lead to a slowing of the economy, and therefore they would pause and ultimately start easing, out on the future. What that did was loosen financial conditions, which is setting us up for what you're talking about, which is maybe a reacceleration of the economy or things getting better. It's probably one of our concerns around rates, in that as the economy does better, rates could move higher. I think the most important element, though, is when we look at that core PCE number, it was a surprise, very similar to the non-farm payroll number that we saw at the beginning of the month. And it puts the Fed in a really difficult position.
So what type of landing are you anticipating? And have we overdone this analogy?
I think so. It's soft landing, hard landing, no landing. We keep hearing about these expectations, but the reality is that we are on a lower growth trajectory going forward. And the Fed is trying to engineer a slower growth outcome for the economy to take care of the inflation problems that we're dealing with. So, hard landing, soft landing, I really don't want to get caught in the definitional terms of how we get there. What I view as critically important is the more aggressive the Fed has to be around fighting inflation, the greater the risk of a hard landing or a much greater slowdown in the economic outlook and the economy.
So we've been talking throughout the show and really throughout the past few days, the conversation around volatility has really been ticking up, that people are buying more protection in this market, perhaps because they're worried about some of the stuff you're talking about. What does protection look like for you right now? Is that the sort of tack you're taking?
Well, I think protection in general is a defensive positioning in our portfolios, making sure that we have a lot of dry powder to take advantage of that volatility, but also not expressing really strong opinions or views. And when we look at the market, there are a lot of things that could go really right. There are a lot of things that could go really wrong. And when you're at these inflection points, you do get these heightened levels of volatility. I mean, just look at January and February in terms of what we've seen. I mean, a 65 basis point rally in the 10-year Treasury and then a 55 basis point backup. I mean, that's real volatility for investors to contend with. So I think defensive positioning, being very tactical, being very nimble in the market, and then taking advantage of that volatility. Again, I can't stress this enough. I think the Fed has to remain vigilant on inflation. And the more aggressive they are in fighting inflation, the greater the risk of a slower economy in front of us.
So what does that signal to you in terms of how the companies, the sectors that had performed well in the previous bull market will perform even as the Fed continues on its own policy pathway?
Well, great companies do well through good times and bad times. What we really have to watch are the companies that were misallocating capital, taking on too much leverage, getting in front of their skis and this expectation of a much stronger growth outlook. Those are the companies that are going to be vulnerable. And we've seen a lot of that mispricing, or we saw a lot of that mispricing in 2022. Now we're going to really separate the really great companies from just the average companies and the bad companies. And I would anticipate that as we get into the next round of earnings, we're going to see some real surprises as the market continues to adjust for a much lower earnings outlook. And, when you've got a slower economy, it's really hard to drive great top line growth when the overall economy is just kind of muddling along. And so I think we're going to see a much more volatility on the horizon, and we're going to see massive differentiation in valuations in the equity markets and in the credit markets.
So how do you find the companies that are going to do better in this environment? What sort of criteria are you looking for?
Well, you look for durability and resiliency. I mean, companies who have started preparing for a slower growth environment, we see it all around us. Companies are reducing headcount, they're focusing on costs, they're really paying close attention to their margin structure. And those are the companies that will weather a slower growth environment better than others that are not doing those proactive activities within their business. And when it really comes down to it, you have to look at the margin structure of a business and determine the resiliency of that margin structure. And there are plenty of great companies out there that are going to do well in a slower growth environment, and then there are others that are not. And our job as bottom-up fundamentalists, researching companies, one company at a time, is to seek out those companies that are, again, very resilient and prepared for more difficult times in front of us.
Gotcha. Gibson, thanks for joining us. Gibson Smith, Smith Capital Investors founder and chief investment officer. Appreciate it.
Great to be with you. Thank you.
We got some trending tickers for you now. We just talked about pending home sales rising 8.1% month over month in January. Our trending tickers today have to do with the real estate market. JP Morgan says in a new note that housing is showing signs of stability, or at least starting to show signs of stability, and that the down cycle is close to the bottom. That's all in a note initiating coverage of Zillow and Redfin. JP Morgan putting Zillow at an overweight, Redfin at a neutral. JP Morgan likes Zillow's leadership position in the industry as the most visited real estate site. What it says is our solid margins and a healthy balance sheet to help cushion it against continued macro headwinds. Redfin gets the equivalent of a hold rating because JP Morgan says its brokerage model is more vulnerable in a volatile environment. So we're seeing Redfin rise a little bit in today's session. Coming up, more pain. It looks like Twitter is not done with layoffs just yet, including one notable name from the so-called 2.0 era. We'll look at that report next.
Warren Buffett's annual shareholder letter set to be released on Saturday. The letter and what Buffett is buying, of course, is going to be closely watched by Wall Street, given the billionaire's prior investment success, a heck of a lot of it. Our own Josh Schaefer is here with a breakdown of how Buffett became a $100 billion man. How'd he do it?
So when you take a look at Bloomberg's index, it says that Warren Buffett is worth $106 billion today. Nearly all of that is tied to Berkshire Hathaway stock, which Buffett started buying at less than $10 a share in the early 1960s. Now today, one share of Berkshire Hathaway Class A shares costs about $463,000. But as Buffett's bets have grown bigger, some recent buys really stand out. Up first, Bank of America. Buffett famously piled $5 billion into the stock in 2011, and since then, shares have grown over 400%. Some thought Buffett was late to Apple when he started buying in 2016, but Apple shares have also risen more than 400% since he bought. And more recently, Buffett's been an oil man, dumping billions into Chevron and Occidental, with Chevron shares roughly doubling since Buffett significantly increased his position in late 2020, guys.
Okay, so where does Buffett stack up among the billionaires right now?
So he's not number one.
Okay.
We should start there, right? That's Bernard Arnault. He's number one, and then we've got Elon Musk at number two. And what I want to show you guys here, let's take a look at Elon Musk's net worth. See how that chart kind of moves up and down. It looks a little chaotic, right? Elon's still number two, but you can see it almost looks like Tesla's chart, right? To some extent, these billionaires, it's very tagged to what their stock does, right? And then when you look at Mark Zuckerberg's, he also shot up very quickly with Meta, but then see how much he fell as Meta's stock fell. Then when you look at Warren Buffett, the slow process, right? buy and hold, buy and hold. A little bit more of a steady chart there, and significantly more than Zuckerberg. So that's sort of my biggest takeaway when you compare him to some of the other billionaires and maybe the modern tech billionaire, is Warren Buffett has been able to sustain, while some of these other billionaires are really pegged to one stock, one tech stock that has been a bit more volatile in recent years, while Buffett has been more consistent.
Slow and steady wins the race.
Yeah, indeed.
I always taught you that.
Yahoo Finance's own Josh Schaefer breaking down all things the Oracle of Omaha. Buffy the stock market slayer here on the day. Thanks so much, Josh.
Twitter shedding even more jobs over the weekend, cutting at least 200 employees, according to the New York Times. Those cuts affecting roughly 10% of the already slimmed down social media site's estimated staff of 2,000. Before Twitter's purchase by Elon Musk, the company employed around 7,500 people. Here with more is Yahoo Finance's Dan Howley. Dan, we were asking in our morning meeting, who's left at the company? Because these layoffs included some of the people who were helping architect the newer strategy.
That's right. Yeah, that's right. Julie, you're referring to Esther Crawford, and she was one of the people that was trying to get the new remote kind of payment system up and running, trying to get the Twitter Blue subscription up and running. She was the one that famously referenced sleeping on the floor at Twitter's offices, had a sleeping bag and an eye mask on. And so she's apparently gone now in this fresh round of layoffs. And this, as you said, there were around 7,500 employees at first. Elon Musk cut that in half, and now we're looking at the number left. It's around 1,500, maybe. There have been cuts across numerous organizations, whether that's engineering, HR. They've shut down different data centers. So, this really is, there's bills that are being unpaid. Apparently last week, this is according to The Verge, their Slack app was down. Some people say that it was routine maintenance, others questioning whether or not it's because the bills weren't being paid. Elon Musk had said that they may end up kind of just being flat for the year as far as revenue goes, not losing, not making money, but being, just kind of on the flat. And you got to wonder if that's really the case when he's continuing to do these layoffs, or if someone predicted that he's starting to try to install a new kind of Twitter structure that he is personally responsible for and he has put into place.
And Dan, the layoffs coming after a tumultuous week at Twitter. We know that there has a lot that's been taking place at the company. And so within that, what more is still at play over at the firm as they're trying to reassure its own employees that it has enough people to move forward, but also trying to monitor its own finances?
Yeah, look, I don't envy anybody that works at Twitter right now. I think that this is a company that Musk tweets about, saying that the efficiency is improving, says that it's never been used as much as it's used now. He regularly tweets about that. But, just looking from it from the outside perspective and from the various reports, things have been cut so badly that I believe the New York Times had said people had to bring in their own toilet paper to the Twitter headquarters. There's different offices that are being closed just because either their bills aren't being paid or it's a means to kind of ensure that they can get the balance sheets or Elon Musk can get the balance sheet a little more tighter to his side of things. So it's got to be, from an inside perspective, a difficult place to work at this point. This was one of the kind of social media companies where people wanted to flock to. Yes, the structure was never quite tight, and they had their own issues. They were never able to fully monetize as well as something like a Facebook or an Instagram. But, at least it was something that people seemed to want to work for. And at this point, if you're trying to hire engineers, sure, there have been layoffs in tech companies, but there's still plenty of opportunities for engineers around the country. You got to wonder whether or not you would want to work at a place like that where there's constantly a threat of layoffs, even on the weekend. Yeah, roll up with your own toilet paper roll isn't exactly a talent acquisition strategy. Yahoo Finance's own Dan Howley, thanks so much for taking the time here this morning. Coming up, pent-up demand and accumulated savings were very much a 2021 story for the big retailers. So what do the likes of Target and Costco have in their corner in the results next season?
A big week for Tesla, key company earnings, and new reports on the state of the housing market. Here is what you need to know. Tesla's annual Investor Day is on Wednesday. Expect news on new models, battery technology, and the company's latest expansion plans. Elon Musk previewed the event on Twitter in his typically not so understated way, saying the event will be a big deal, not just for Tesla investors, but for all life on Earth. Meanwhile, on the planet Pandora, blockbuster films like Avatar: The Way of Water made megabucks for movie theaters in the past few months. We'll see how it helped the world's biggest movie chain, AMC, when it reports earnings Tuesday. Also, watch for earnings from Yahoo Finance's 2022 Company of the Year, Costco, as well as numbers from Target and Zoom. And industry insiders and the Fed will be on the lookout for the latest durable goods orders and pending home sales. That's all ahead in the coming week. Those, of course, just some of the stories that we're watching this week. One key story, though, is results season for retailers, providing a core indicator for consumer spending and could point to where the greater economy is headed. A potential market downturn could mean tighter margins for names like Target or Walmart, but gains for others like Costco and Dollar General. Here with more is Corey Tarlow, Jefferies equity analyst. Corey, good to have you here with us this morning, and thanks for taking the time, as always. The good thing about Costco 2022 Yahoo Finance Company of the Year is that they actually give us some of their monthly sales figures. So what can we extrapolate from what we've already gotten reported from them and kind of apply to what's set to be reported?
Sure, and good morning, Brad. Thanks for having me on the show. So I think to start, what I'd say is that the consumer has clearly become a little bit more pressured. So savings rates continue to be in the low single digits versus pre-pandemic averages, which are in the low double digits. Revolving credit balances continue to increase. So people are saving a little less and they're buying on credit a little bit more. And so clearly the consumer's looking for ways to stretch their dollars a little further. And the value retailers, whether it's Walmart or Costco or Dollar General, are really great ways to do that. And as it relates to Costco specifically, sales continue to be strong. But what we are seeing is that in some of the more discretionary categories, the consumer's starting to pull back a little bit. So Costco's non-foods category, for example, was down in the month of January, and it was also down in the month of November too. And prior to that, it wasn't down since the onset of the pandemic. So I think what's clear is that the consumer's becoming a little bit more intentional with their dollars, and you're starting to see that be reflected as inflation continues to run at a relatively elevated pace.
Hey, on the flip side, though, Corey, hey, it's Julie, by the way. Is Costco going to gain some market share on the non-discretionary side because of that value proposition that you're talking about?
Morning, Julie. So yes, I think that what our data is showing us is that some of these larger value retailers with a lot of scale and really affordable prices are where the consumer is gravitating toward. And as a result of that, these retailers are gaining share and it's benefiting their sales numbers. So we saw that with Walmart when they reported last week. We've seen that so far in the last 12 months with Costco. And we've seen it with Dollar General too. So I think net, if you are a value retailer with affordable prices and a convenient offering, that bodes pretty well as we look into a potential recession here.
What does that mean for some of the homegrown brands? I mean, we've talked about this with Walmart, and they discussed it on their earnings call and some of the consumer shifts that they are seeing. How does that translate as well into Target and even Costco from what you're expecting? A lot of people out there looking for those Kirkland golf balls, Corey.
Yeah, they are great golf balls. I can comment anecdotally, but what I will say is that number one is that people are going to these stores a little bit more. Maybe they're buying a little bit less overall in terms of the total dollar value of their transactions. But what they're also doing, very interestingly, is they're shifting to private label. Why? Because it's slightly more affordable and it's typically similar quality to that of the name brands. And The way that these stores are typically assorted is that they'll have the name brands and the private label products right next to one another so that consumers can compare them. And what we're seeing is that as consumers are going through their shopping trips, they may even sub out some of the name brands for private label products as they get to the end of their shop. So what is clearly being illustrated here is, again, what I talked about at the beginning, which is the consumers becoming really stretched. And it bodes really well for those retailers that are value oriented, like you mentioned, like a Costco or a Walmart.
And what about Target?
And the other,
sorry, Corey. Just
sure.
to split. I'm really curious about Target this time around, right? Because man, did they struggle last year. Walmart had some issues too, but Target really seemed to catch the brunt of the inventory correction and not being prepared for it. What are we going to hear from Target this time? Have they gotten their ducks in a row here? Are they back on track?
I would think so. So there's a couple things that I'd say here. Number one is that Target has a great value offering. So it has prices that are competitive with that of Walmart and Costco. But number two is that it is really a lot about the margin recapture story this year. So you talked about the inventory issues that Target had last year. The inventory issues are largely corrected now. And so if we look over the last decade, Target generated a 7% operating margin. This year, maybe it'll be close to 2 or 3. So there's a lot of margin recapture opportunity as a result of a lot of the markdowns that Target had to take last year. And I think that is going to be a really significant driver for Target stock over the next 12 months that people are underappreciating at present.
One of the things, Corey, that I've been tracking within retail is the way that consumers are transacting and where they're deploying cash, where they're tapping into some of their credit cards as well. I wonder if there's anything interesting in data that you've seen so far in the environment that points to where there could be some strength or some weakness as some of the banks have continued to classify consumer or household balance sheets as healthy or resilient.
Yeah, I think it's a pretty simple story. Consumers are stretched, and so they're rotating into things they need instead of things that they want. And we saw this with Walmart's report when they reported last week. We saw it with Costco's results. And what we've seen is that food, i.e. consumable products, continue to be up, whether it's mid to high single digits or even higher than that in some cases, in some categories. But non-foods, and particularly some of the bigger electronics or more discretionary items, are actually starting to decline a little bit on a year-over-year basis. And so a lot of these retailers that have both of those offerings are seeing the discretionary side come in a little bit weaker than perhaps we would have thought.
Well, we're going to keep an eye out for those trends in some of these upcoming earnings. Thanks, Corey. Appreciate it. Good to see you. Corey Tarlow, Jefferies equity analyst.
Thank you.
Thank you. One programming note, be sure to tune in after Costco earnings on Thursday. Brad Smith's got another long day on his hands. He's got a breakdown of those numbers and what it means for your investment. You don't want to miss that in After the Call. Coming up next, though, the economic illiterate. Warren Buffett takes a swipe at those who do not like share buybacks. Was he referring to the president, perhaps? We're going to get the take from DC next.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: it is those dedicated savers that are forefront in my mind as I write this letter. He adds, Charlie and I are not stock pickers, we are business pickers, telling people to save money. And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, the lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s as well. Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in DC, noting this: Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter, no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Salzi out.
Millions of student loan borrowers now turning their eyes to the Supreme Court as it gears up to hear arguments over President Joe Biden's student debt relief plan. For more on what the Supreme Court justices are likely examining, let's get to Yahoo Finance contributor Kevin Cirilli. Happy Monday, Kevin. Good to see you.
Good to see you too, Julie. Look, I mean, there's a couple of narratives that we've got to be on the lookout for Tuesday's Supreme Court case as it relates to student debt. Remember that there was a district judge a couple of months ago that struck down and dismissed the lawsuit that came before them as it relates to whether or not President Biden's student loan forgiveness program was okay and was by the book. So the Supreme Court actually, one path that they could take, which is many people are saying right now is unlikely, but they could dismiss this. And if that happens, then President Biden's student loans program and forgiveness program stays in place. Now, this is where it gets a little more tricky. Let's say that they continue this case. We would anticipate a ruling sometime at the end of the Supreme Court's term, sometime in July or August this summer, where they would rule on this. Remember, 6 Republican-led states have argued that this program, $400 billion worth of student loan forgiveness, is illegal. And so if that happens, then this is what I would anticipate, that the Biden administration would have another go at it. And what they would essentially try to do as they inch forward into 2024 is to make student loan forgiveness a key issue, a political issue for voters to decide on. Either way, the student debt forgiveness program, which impacts, again, $400 billion worth of folks who earn fewer than $125,000 annually, this issue is not going away, and it has become a very polarized issue, but it kickstarts on Tuesday before the Supreme Court.
Kevin, while we have you, we got to discuss some of the sanctions and how they might be likely to escalate in response to Russia receiving chips and other support from China in some of the geopolitical news that we're following.
Well, it's a great question because last week we talked about how China and Xi Jinping are cozying up to Russia and to Vladimir Putin, and they've scheduled this meeting, face-to-face meeting, in the coming weeks and the coming months. Now, they've also put out something like a 12-step plan, which has been collectively met with an eye roll and a shrug here in Washington, D.C. from both Republicans and Democrats as it relates to China somehow trying to play peacemaker between Russia and Ukraine, specifically when China has not followed NATO, followed strategic partners, followed the United States, followed Ukraine in issuing sanctions and issuing export controls against Russia to get them to stop. The West and democracies believe that the best way to get Russia to stop their war with Ukraine is to put economic pressure on them. China refuses to follow along with that. And now there's new reporting, and Jake Sullivan was out on CNN with Dana Bash over the weekend saying this, the president's national security advisor, that China has actually been helping Russia skirt some of the export controls and sanctions that have been put in place by the West, or even facilitating Russia to get chips. And where are these chips going through? Turkey. And so that's raised new questions specifically about how China sees this relationship with Russia in the long term. And again, Jake Sullivan saying that should China continue down this path, that they're going to face geopolitical risk of their own from an economic standpoint. The Biden administration has continued with the U.S. policy of some of the previous administration's export controls and sanctions levied against China. And candidly, from the comments over the weekend, it's looking unlikely that they will be lifted anytime soon.
Right. Yes, that's definitely something we've been hearing as well. Thing three for you, Kevin, this morning. There's been a lot of talk about whether President Biden is going to run again for president in 2024. He says he's gonna, but maybe there's a little bit of wavering of that resolve. I don't know. Tell me what the word is in Washington.
Well, look, I mean, Marianne Williamson, who's a New York Times bestselling author, she ran for president back in 2016. She's moving forward with running. This is a long shot candidacy for sure. But what it does, Julie, quite frankly, is it opens the door for other Democrats who could pose a challenge to President Biden in a primary to say, hey, you know what, if Marianne's already running, then why not me? And so that's when it gets interesting when you have conversations with people who are allies of Senator Joe Manchin, a centrist from West Virginia, who candidly has not ruled out running as some type of unity ticket with like a Liz Cheney or someone more progressive like Senator Elizabeth Warren from Massachusetts. So he's going to have a definitive declarative statement on whether or not he is going to run. And it seems like we're moving toward that inflection point relatively soon. But he's faced some low approval ratings, and whether or not he can rally progressives to turn out to vote for him in what's looking in contrast to be a crowded Republican field remains to be seen.
Yes, we'll keep in touch with you as you stay on top of that. Thanks so much, Kevin Cirilli. Appreciate it.
Thank you.
Well, that 1% tax on stock buybacks went into effect at the start of the year. And since then, President Biden has committed to raising it further.
Corporations ought to do the right thing. That's why I propose we quadruple the tax on corporate stock buybacks and encourage long-term investments. They'll still make considerable profit.
Of course, that was from the State of the Union. Warren Buffett, though, he's given buyback critics some pushback in Berkshire Hathaway's annual shareholder letter this past weekend, calling them, quote, either an economic illiterate or a silver-tongued demagogue. Not sure which category he would put the president in. Maybe both. Unclear. Let's get to Raymond James Washington policy analyst Ed Mills to weigh in. Definitely, Buffett is not alone in pushing back against that buyback negativity. Ed, I mean, is there any realistic chance in Washington that we could see an increase on that buyback tax?
Julie, I give it a low probability, but I think that really what this is about is setting up a straw man. That as we get into the debates about the debt ceiling later this spring and early into the summer, Republicans have said that they want to kind of talk about our fiscal house in the United States. And what Biden will say is that, you know, they talk about this, but they're not asking Chevron, that just announced a $75 billion buyback, to pay a penny more. And so he's trying to set up that contrast. So I don't think it happens, but I think it's going to be more part of the conversation, Julie, than I think the market anticipates right now.
Okay, and so with the market's anticipation of how it may move forward, you know, what does that do for some of the CEO or the board calculus right now and what they're communicating even ahead of a furthering of this movement from Washington?
Well, I think it just is the economics here. I don't think there is a CEO or CFO who should make a decision about their capital management based upon a 1 or even 4% kind of cost to them. That this should be really about what is best for capital management long-term for the company. Clearly, part of what this is trying to do, Brad, is to move more capital management to dividend distribution because that gets taxed. And so really the conversation is, how do corporations run themselves? And is there a way for the United States government to tax that activity? That's really what they're trying to do here.
Ed, it's so fascinating with this administration. I mean, a lot of administrations are like this, but perhaps this one uniquely so, in terms of pushing back on American corporations and setting them up, perhaps setting up certain issues as straw men, as you alluded to. And then on the other hand, doing things to help. I'm thinking of the CHIPS Act in particular in this case, opening up the grant process for $39 billion being allocated. You highlighted that in a recent note. I'm going to be talking to the Commerce Secretary about this very issue. How much is that going to be an economic driver? Obviously, it's longer term, but how important do you think it is?
Yeah, Julie, this is so fascinating because, oftentimes we look at government as being more a stick and regulations being a negative. But in the last 3 years, when you put together the infrastructure bill, you mentioned the CHIPS and Science Act, you look at what was in the American Rescue Plan or the Inflation Reduction Act, and I've added up at least $1.5 trillion of real carrots to industry, Julie. And I think there's an argument to be made here that the United States is at the beginning of an industrial renaissance, not the way in which we normally think about this, but really through two lenses. One, through a national security lens. And so if we as a country have identified a national security risk, such as TSMC, they produce all of the leading semiconductors in Taiwan, that's geographically really vulnerable. So let's invest here in the United States. The other area is on climate. The Inflation Reduction Act, I'm not sure if I believe this, but the estimates is that if this all gets done, that's a 30% reduction of emissions by 2030. You would have never gotten a Congress to vote for that as a stick, saying U.S. businesses must reduce these emissions. But by having so many incentives on clean energy technology, you might have that policy play out. So it is a really fascinating change in terms of the way DC, especially the way Democrats in a area where they've been demagoguing on anti-corporation activities to have these provisions and have an industrial renaissance potentially here in North America.
And so, Ed, I know it's not even March of 2023, but how much of that industrial renaissance also will only accelerate further or is kind of hinging on what the results of the general election in 2024 look like?
So I would take it a step earlier than that. I would say how much of this is hinging on a potential permitting reform or energy bill that gets passed in this Congress, because the Inflation Reduction Act was only step one of being able to do any of this. If you can't have the permitting, if you can't have the transmission being built to get this done, it doesn't matter what the 2024 election will look like. A lot of these goals will not occur. So perhaps the thing that I'm watching the most here in DC, is there some consensus, especially if there is a spike in commodity prices? Republicans really want to do an all of the above energy bill approach. You might actually get Democrats, you might get the Joe Manchins of this world on board if it furthered the goals that have already been so heavily invested in.
Ed, I'm curious also to go back to that sentence that you said, the United States is in the beginning of an industrial renaissance. I mean, that's probably something Joe Biden would like to rerun for election on, right? That's a pretty good line. Do you think that the Democrats are capitalizing on their achievements enough for that political push?
Yeah, it's a great question. And I do think that it's absolutely a line that he'd like to run on. I don't think that they have sold that enough. And I do think that one of the questions that they've had in times past, if you remember, Joe Biden was the head of the kind of big stimulus bill at the beginning of the Biden administration and all those shovel-ready projects. And you go a couple of years later and the shovels haven't actually dug any ground yet. And so this is an administration that seems to be cautious in the way in which they sell things because they don't want to overpromise and underdeliver. And so what I'm watching this year is, are we going to see even things that build upon this in biotechnology, in clean energy technology? And once the foundation is fully laid, that's when they start in the 2024 election really running on this.
To what extent is the industrial renaissance in the U.S. also contingent on what the geopolitical framework looks like over the coming months and even the next 2 years?
So I think the geopolitical framework is one of the biggest catalysts here. We look at the vulnerability of Taiwan and we get the CHIPS and Science Act. The next thing I think we're going to focus on is that we've identified 50 critical minerals for the production of a lot of this clean energy technology, other very important national security items. And we get more than 50% of that from China. There's 12 of those 50 critical minerals that we get 100% from China. So that's going to be driving this. And I think that when we layer on Russia, Ukraine, it questions whether or not the world order that has existed for the last generation can continue. And so we have to look at things through a national security lens and saying, what is the supply chain? If it gets disrupted, do we have what we need here in the United States? Does a neighbor have it in North America? Does a friend have it in Europe? And that's where we invest. It doesn't matter about widgets or if shoes are manufactured in a certain place, but if it's a true national security issue, that is going to get investments. And that's where we're going to see a lot of carrots being developed, not only in this administration, but I think potentially in a bipartisan way through Congress.
Raymond James, Washington policy analyst Ed Mills. Ed, great to get some of your time this morning. Appreciate it.
Thank you.
Coming up, everyone, rush hour. Yeah, not the movie. Do you want to avoid the crowds or go where the action is? Well, our next guest is going to go through the busiest trades on both the long and short sides. Amid growing market uncertainty, new research shows a wide variety in crowded long and short stocks among active investors. Joining us now, we've got Ihor Dusanivsky, who is the head of predictive analytics at S3 Partners. Ihor, always a pleasure to speak with you and get some of your insights here. I mean, the big question that many investors may have out there is what they should be looking for in companies that are perhaps the most vulnerable here in either side of the trade.
Sure. Well, thanks for having me. What we saw was a ton of deleveraging in the active investors, hedge funds and such, in 2022. 2023, we're seeing that there's more leveraging, more asset accumulation, both on the long side and short side by hedge funds. The big names, Microsoft, Apple, Tesla, are getting the brunt of the dollars, but there's a lot of names that are crowded that really you have to watch out for because you might have moves in and out that really can affect stock prices.
Well, and I want to skip to what you're deeming the most squeezable shorts, Ihor, because I got to say that was the most intriguing part of the research that you sent us. First of all, what makes a short particularly squeezable?
Bottom line, If you're losing money in a trade, you can get squeezed out of the trade. If you're making money in a crowded stock, you're going to stay in the name. It really is, you get the tap on the shoulder if you start pulling in red numbers and you start having losses. So these names that are crowded and are losing money.
So is it as simple as looking at some of the companies that have either been part of the meme or Reddit retail trade in the past, or even at companies that have had precipitous declines over the course in 2022? Or is there something else that you would be looking for under the water?
Well, meme stocks help because define a squeezable stock because they're tighter. They have a larger percentage of their short interest that are shorted. Their trading volume goes up and down a lot. But really, I'm looking at losses. Like I said, no one gets out of a profitable trade. You see something like Lucid has a big move in the past couple of months. That's a squeezable stock. Shorts are bleeding on this name. AMC, same thing, especially with the new ape shares that are possibly getting into play. There's a lot of P&L that's sitting around and causing shorts to double think their positions.
And what then tends to trigger that short squeeze? Is it, in some cases, maybe a news event that sends the stock higher? Is it more sort of a market momentum situation? All the above? What ends up happening?
Sure. I mean, market momentum plays in both the long and short side. That's become a new piece of the puzzle in the market now. Before, everyone's a value fundamental investor, and you kind of said, oh, is this company profitable? I'm going to buy it. Now you got to watch out that, hey, this might be a profitable company. The street hates it. I lost money. So we're looking at both sides. And our new map product is looking at the crowded longs and crowded shorts and squeezable shorts and kind of telling people, hey, watch out for these names because there's a volatility in prices in these crowded names.
And Ihor, what's also interesting to me is there's so much overlap between the largest active longs and the largest shorts that you're looking at. Microsoft is on both of those lists, Apple's on both of those lists, Tesla's on both of those lists. So, I mean, is it just a function of them being very actively traded, or what's going on there?
There's kind of a market issue here that there are less stocks, especially less stocks that are mega and large cap names, where the hedge funds who have a lot more money need to invest their money into. So I'm not going to invest. If I have a $15 billion hedge fund, I'm not going to take a $10 million position in a micro cap name. I don't need to manage 1,000 stocks in my portfolio. What I need to manage is a handful of names that I can control and do a lot of risk management on. So what I'm doing is investing in larger names. And if you're investing in larger names, you're going to invest in market leaders. So you got your Apples, Teslas, Microsoft, Nvidias, Visa, and so on, as the most held long and short. So really, the scary thing is you got guys on both sides of the market. So when you have market news, one side wins, one side loses, you start seeing action, buying, selling, buying to cover, short selling, and really just makes the stock prices on some of these names have these one-day volatilities that really could scare the hell out of some investors.
Ihor, some of the names that have had the most volatility this year are names that still touch crypto. When you think about the landscape there, and even recently there's been some data that's emerged about the number of crypto whales that has gotten back to pre-pandemic levels. With all that considered and the volatility in crypto prices, what would you be watching for with crypto stocks and equity market names?
Sure. I mean, you've got the investing in a crypto coin is one way to look at the market on for cryptocurrencies and blockchain, but a lot of people just can't do that or don't want to do that. So you look at some of the underlying stocks, the micro strategies, that have an innate or Square that have a lot of exposure to these cryptocurrencies, and that's an easier way to either buy or sell cryptocurrency instead of having to have a wallet.
Ihor, it is indeed. Thanks so much for being here. Always good to catch up with you. Ihor Duzanowski, head of predictive analytics at S3 Partners. Talk to you soon, Ihor. Thanks.
Great. Thank you.
Coming up, we're going to check in on the markets, look ahead to the next hour of trading. Stay with us. As our artificial intelligence continues to take the world by storm, You.com is one of the players in the industry looking to take on Google and other tech giants. Brad Smith, that guy right next to me, is going to speak with the CEO and founder of the AI search platform in the next hour, all about the company's outlook and the AI landscape. Looking forward to that.
I am too, everyone. And the oil market is looking a lot different today than it did a year ago before Russia's invasion of Ukraine. We've got Paul Sankey of Sankey Research coming up to break down all things happening in oil and commodities. And that's not all. Occidental Petroleum earnings, they're going to be out today after the market closes. We'll get a check on how the company performed in the last quarter. Yahoo Finance is all over that later in the day with CFRA energy equity analyst Stuart Glickman, going to break down all things Oxy. Lots that we've been tracking here on Oxy, especially coming off of Warren Buffett's shareholder letter.
Yes, indeed.
This weekend, too.
And let's take a look at what's going on with some of the home building related stocks here. We got pending home sales at the top of the hour here. And those are some home builder related things. It's XHB is the home builders index, but then, or ETF, I should say, but then some of those others are like home building DIYs. Yes, exactly. And let's take a look at the markets broadly as well here as we head into the 11 a.m. hour. Hanging on to gains, but they are a little bit smaller than they were when we got underway here today, but still seeing a little bit of a bounce back from the selling that we got last week. The Nasdaq holding on to a gain of about 0.75%.
Yeah, all 11 S&P 500 sectors still in positive territory, just about 90 minutes into the start of today's trading activity.
And you're in double duty. Brad Smith is going to be sitting right here for the next hour of trading. Rochelle Akufo is off today, so we told you some of what's in store. So stay here. Brad's doing more.
Don't go anywhere. We can keep talking. Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West Coast. I'm Brad Smith. And here's what I'm watching this morning. Stocks look to make a comeback after the worst week of 2023, but there's a lot of catalyst in the days to come. Retail results from Target or Target and Costco. They're going to provide food for thought for investors. We'll take a closer look. And the AI train chugs along. Everyone and their grandma looking to get into the ChatGPT game. Tencent and Snapchat, the latest names reported to be developing their own versions. We'll deep dive into all of that. And adding to the confusion, a report from the Wall Street Journal suggests a U.S. agency is backing the Wuhan lab leak theory. Is there a growing divide in the intelligence community? Big question here this morning. We discuss this hour. But first, let's take a look at the major averages here in the U.S. You've got the trifecta, the hat trick taking place across the board for those U.S. major averages. The Dow up by a little more than 0.5%, 184-ish points there. S&P 500 up 0.7%, and the Nasdaq Composite tech-heavy average up about 0.8%. Let's also check in on the Treasury market here, taking a quick look at some of the yields there, down across the board, fractional declines there for the 5-year, the 10-year, and the 30-year yield here on the morning. Let's also take a wider look at where investors think the market is headed this year. One big name weighed in over the weekend, none other than Warren Buffett himself. In his annual letter to shareholders, a key quote, Buffett comments that stocks often trade at truly foolish prices, both high and low. A warning to ignore the noise around the markets. The Oracle of Omaha had also chosen some very select words for naysayers of share buybacks, saying that they are either, quote, the economic illiterate or a silver-tongued demagogue, and adds the characters are not mutually exclusive. Let's take a closer look at where stocks are headed and whether we'll see a bottoming out. Joining us now with more, we've got Caterina Simonetti, who is the Senior Vice President and Private Wealth Advisor over at Morgan Stanley Private Wealth Management. Thanks so much for taking the time here this morning. First, the major item from you that perhaps sticks out from this weekend in Warren Buffett's shareholder letter. What would you be really keying into here?
Well, Brad, thank you for having me on the show. And Warren Buffett certainly is hard to ignore. When you think about it, the focus of last year was inflation and Fed action, and we seemingly underestimated inflation. And now we're seeing the results of it. And the big surprise for this year is, of course, broadly, we thought that, by early this year, as a matter of fact, right now in February, Fed would be done raising rates. But economic data surprised us to the positive. And so Fed is going to continue. But as we look at this and as we continue to focus on the Fed, in our view, the focus should be on the earnings revisions, because this real story for 23, in our view, is the fact that it was easier to be profitable during the times of the high inflation. As inflation is coming down, these profit margins are harder to find. And the US company specifically are going to be revising their earnings and setting them to the more normal level. And it's going to be really viewed by the market as a negative, as it should be. And we think that this is what is really underestimated by the general investing public. And so we think that there is a lot of risk in this market, and that the risk reward is just not there, so which gives us a lot of caution. So
we've already started to see some of that guidance reset in the most recent, or the kind of earnings period that's accounting for the most recent quarter, Q4 2022. Do you believe that there's still more to come?
Well, absolutely, because when you think about what we're just coming out of, is the pandemic was not the normal environment. So earnings were somewhat skewed to the environment. And then immediately after the pandemic, we had this the historically high inflation. So what is now? What is normal? And this is what we're going to be defining. So we think that the earnings have a long way to go. The stocks seemed highly overvalued. We think that there is going to be another leg down that will be pretty significant. And in our view, it's something that almost needs to happen in order for us to pivot our way into the next bull market. But we think the bear market is not over. But with that said, this is also not us saying that there are not opportunities in this market. Sometimes the best opportunities, specifically for stock picking, for improving the qualities of the portfolios, is exactly here in this volatile markets, where we have really a great option to improve improve the positioning of our portfolios, both tactically and strategically.
Right, and so that kind of dovetails into my next question, which is if you have a client that reaches out to you on the wealth management side and they say, hey, you know what, Katerina, I want to take some risk right now because my time horizon is 3-5 years, maybe even longer out from now. What do you tell a client in that capacity?
First of all, I love your question because we have to pivot our thinking from the time horizon of 2 months, 3 months, 6 months into a couple of years out. Because if we think that way, there is a tremendous amount of opportunity in this market. And what we tell our clients is to stay defensive, focus on high quality dividend paying stocks in sectors like healthcare, like financials and utilities. There is also a change in the environment in comparison to the last year that there is actually yield out there. Interest rates are high. So all of a sudden, investors can actually make money on bonds. So this combination of blue chip dividend paying stocks plus higher yielding bonds is what is going to carry us through this volatile time. And we have to remember that technology was the leading sector during the last bull market. And we're not saying that we're not excited about some of these really attractive tech names, but we have to also consider that this might not be the leading sector in the next bull market, that there might be different market leadership going forward.
Katerina Simonetti, Senior Vice President and Private Wealth Advisor at Morgan Stanley Private Wealth Management. Thanks so much for joining us here this morning. Appreciate it. Switching gears, everyone, sports-centric streamer Fubo TV seeing a positive move as consumers shift to costlier subscriptions. Here with more on their earnings and how the service stacks up to its streaming peers. Of course, we've got Yahoo Finance's Alexandra Canal. Allie, what do we know about Fubo's earnings thus far?
So interesting story here with Fubo. Very positive earnings, but we're seeing shares reverse earlier gains down about 15% due to dilution. The company disclosing it sold 36.7 million shares for gross proceeds of $68.1 million in block trades under the company's at the market program. They sold 17.5% of shares outstanding. So the fact that the stock is now down about 15%, that makes sense given the news. But in terms of the quarter, the company did report a beat on both the top and bottom lines. Q4 revenue coming in at $319 million on a net loss of 76 cents a share, so a narrower loss than expected. In addition to that, we saw full year 2022 revenue surpass $1 billion for the first time. That represents an increase of 58% compared to 2021, and that included $100 million in advertising revenue. We know how shaky the ad market has been, so another positive story there for Fubo. And then on the subscriber front, we saw them jumping, closing the year with 1.45 million paying users in North America, and that's despite higher planned pricing. The company is really focused on price increases to drive down that cash burn, which has been a big drag on the stock, and Q4 did represent the lowest level of quarterly cash usage in Fubo's history as a publicly traded company. And then finally, on the earnings call, there were a few points made on how Fubo plans to handle competition. Management has really emphasized its sports first strategy, calling it the differentiating factor there in the streaming wars. And it certainly helped in the quarter with the start of football season in addition to the World Cup. Another thing that stuck out to me, we've been talking a lot about AI and how artificial intelligence has been a big buzzword in a lot of these recent earnings. And Fubo TV said AI will be the future. It's going to be very important when it comes to the advertising experience, the overall customer experience. They said that AI is a natural evolution and it will allow sports fans to engage on a per play basis, not just a per game basis. So look out for some potential updates there, as we know that's sort of the future with all of these companies right now.
Yeah, absolutely. We know that you've been tracking one thing as well. You've been watching Goldman Sachs here, and they're set to have their investor day soon. So what are you expecting there?
Yeah, I mean, Goldman obviously has been in a bit of a rough period right now, especially during a very tough 2022. So tomorrow's Investor Day, it's going to be an important one to set the tone for 2023. I expect to hear more details about the asset and wealth management business. That has been branded as key to unlocking value, especially after the bank revealed its consumer banking unit lost nearly $6 billion, a huge disappointment to investors and industry watchers. That set off a ton of alarms with with CEO David Solomon. He has been under heavy criticism in the process. So investors are going to want a detailed plan. Where does Goldman go from here? Is there a path to a better multiple? That is going to be key. What is the execution plan? And that's the narrative that I'll be tracking very closely tomorrow.
Yahoo Finance's own Ali Canal, thanks so much. Appreciate it.
Thank you.
Definitely. Guys, coming up, we take a closer look at Meta's paid verification feature and what it means for the tech giant's future. Are you paying? Are you buying? Let us know. Holler at us on Twitter. That's next. Meta taking a page from Twitter's playbook as it plans to launch a new subscription service that will allow users to pay to become verified. Meta's paid verification push, it aligns with its year of efficiency ambitions. However, it has its pitfalls. Here with the details, we've got Yahoo Finance's Ali Garfinkel. Ali, what do we know?
Great to see you, Brad. So Meta lost $600 billion in market cap last year, so it's not surprising that they're looking for new avenues to generate some revenue. And that, of course, is paid verification in this particular case. Now, it's not a straight line for them. There are a couple of concerns. The first one is cybersecurity. On Meta, on any social media platform, there's a central question, which is, are people who they say they are? When that is not the case, that is known as account impersonation. Now, lest you think this isn't something that's common, account impersonation was up 288% in 2022. So it's a common thing, and it is a concern. And we do know from what we've seen with Twitter that paid verification can increase in account impersonation. Now, so that's number one, and that's something that Meta has to be concerned about and has said that they are concerned about and taking steps to avoid. Now, the second concern is a more economic one. How will paid verification affect the value of verification? I spoke to a couple of influencer experts who said that there used to be an ecosystem where people would pay tens of thousands of dollars. In some cases, the going rate for a campaign to help you at least get on the table for verification was about $30K. Now, that is maybe going to go away entirely and revamp how the influencer economy views verification. One influencer I spoke to said that the social media community is already devaluing verification, and it hasn't even rolled out in the United States yet. That, of course, would mean they have concerns about that would mean it wouldn't be the revenue generator that they would hope for. Now, in the end, this all comes down to execution. There is an optimal scenario for Meta here, but they need to create it.
Okay, Allie, yay or nay? We got to go, but are you paying for this?
Nah.
Not
a chance.
All right, there we go. Yahoo Finance's own Allie Garfinkel. Thanks so much, Allie. Appreciate it. Tracking all the details on Meta's verification push there. Also, the EV space, one we're tracking closely, as you know, celebrating some big wins this morning. Tesla announced higher than expected production levels out of their Berlin plant. With more, we've got Yahoo Finance's Pras Subramanian tracking all the deets there. Pras, what do we know so far?
Yeah, it's a big milestone for Tesla in Berlin, 4,000 EVs a week. They hit that milestone a couple weeks ago, according to Reuters, ahead of their planned timing for that, which is nice to see. That's going to be around 200,000 a year in terms of annual output if they can get that. Now, theoretically, that plant can do 500,000 a week or 10,000, 500,000 a year, 10,000 a week, which is a lot of numbers there, but they're not quite there yet. So some ways to go. Now, it's not all good news here because Tesla had to shift battery. They want to ship battery production to the U.S. because of the IRA, so they're not going to do that in Germany, but they'll build the cars there. But good news nonetheless, because, Musk once called these new factories like Giga Berlin, Giga Austin, money furnaces, right? So we finally trying to get some value out of that after the huge kind of investments into those two new factories.
Yeah, and a major investment within the past 2 years that we've seen into China as well, Giga China. And meanwhile, we know Chinese automaker Li Auto shared soaring forecasts for their first quarter sales. So what can you tell us about that EV maker?
So Q4, they missed estimates, but Q1, they're seeing revenue come in $2.7 billion, up topping estimates there for them. They're topping their range of 3 new EVs. They just make SUVs there, apparently. Their L9 SUV helped push revenue higher, selling prices higher as well. They sell these things called range extender EVs. So basically, it uses a gas motor to power to create power for the batteries and the EV motor that actually propels the car. So a bit of a different technology there. Not all good news is lithium prices sort of hit margins, but that's going to be expected there. But still, they're aiming for 300,000 vehicles next year. Pretty strong stuff. I think the industry might see 1.3 million or so EVs sold in China. So that's healthy numbers there. We've seen a bit of weakness in China because of incentives kind of going away. Potentially COVID issues. So good news here for Li, kind of seeing the industry sort of evolve more.
All right, tracking all things the business of mobility, Yahoo Finance's own Pras Subramanian. Thanks so much, Pras. And coming up, the push-pull, a stronger dollar weighs on oil this morning, but with geopolitical concerns on the rise, the seesaw for crude oil is probably far from over. More with our analysts next.
Warren Buffett's annual shareholder letter set to be released on Saturday. The letter and what Buffett is buying, of course, is going to be closely watched by Wall Street, given the billionaire's prior investment success, a heck of a lot of it. Our own Josh Schaefer is here with a breakdown of how Buffett became a $100 billion man. How'd he do it?
So when you take a look at Bloomberg's index, it says that Warren Buffett is worth $106 billion today. Nearly all of that is tied to Berkshire Hathaway stock, which Buffett started buying at less than $10 a share in the early 1960s. Now today, one share of Berkshire Hathaway Class A shares costs about $463,000. But as Buffett's bets have grown bigger, some recent buys really stand out. Up first, Bank of America. Buffett famously piled $5 billion into the stock in 2011, and since then, shares have grown over 400%. Some thought Buffett was late to Apple when he started buying in 2016, but Apple shares have also risen more than 400% since he bought. And more recently, Buffett's been an oil man, dumping billions into Chevron and Occidental, with Chevron shares roughly doubling since Buffett significantly increased his position in late 2020, guys.
Okay, so where does Buffett stack up among the billionaires right now?
So he's not number one.
Okay.
We should start there, right? That's Bernard Arnault. He's number one, and then we've got Elon Musk at number two. And what I want to show you guys here, let's take a look at Elon Musk's net worth. See how that chart kind of moves up and down. It looks a little chaotic, right? Elon's still number two, but you can see it almost looks like Tesla's chart, right? To some extent, these billionaires, it's very tagged to what their stock does, right? And then when you look at Mark Zuckerberg's, he also shot up very quickly with Meta, but then see how much he fell as Meta's stock fell. Then when you look at Warren Buffett, the slow process, right? Buy and hold, buy and hold. A little bit more of a steady chart there and significantly more than Zuckerberg. So that's sort of my biggest takeaway when you compare him to some of the other billionaires and maybe the modern tech billionaire, is Warren Buffett has been able to sustain while some of these other billionaires are really pegged to one stock, one tech stock that has been a bit more volatile in recent years, while Buffett has been more consistent.
Slow and steady wins the race.
Yeah, indeed.
I always taught you that.
Yahoo Finance's own Josh Schaefer breaking down all things the Oracle of Omaha. Buffy the stock market slayer here on the day. Thanks so much, Josh. A big week for Tesla, key company earnings, and new reports on the state of the housing market. Here is what you need to know. Tesla's annual Investor Day is on Wednesday. Expect news on new models, battery technology, and the company's latest expansion plans. Elon Musk previewed the event on Twitter in his typically not so understated way, saying the event will be a big deal, not just for Tesla investors, but for all life on Earth. Meanwhile, on the planet Pandora, blockbuster films like Avatar: The Way of Water made mega bucks for movie theaters in the past few months. We'll see how it helped the world's biggest movie chain, AMC, when it reports earnings Tuesday. Also, watch for earnings from Yahoo Finance's 2022 Company of the Year, Costco, as well as numbers from Target and Zoom. And industry insiders and the Fed will be on the lookout for the latest durable goods orders and pending home sales. That's all ahead in the coming week. One story that we're also focusing on to begin the week, energy markets wavering in the start of the year over concerns about lowering demand. This is as the market considers shocks like China's snap post-COVID reopening and as fears of an energy crunch in Europe diminish. Stocks like Chevron and Warren Buffett favorite Occidental Petroleum watching for more free cash flow on the back of higher oil prices. For more on the outlook for oil, let's get to Sankey Research's oil, gas, equity research analyst, Paul Sankey. Paul, great to speak with you here this morning. First and foremost, when we think about Chevron here and the analyst day that's ready to take place, the investor day ready to take place, ahead of this event, there are a lot of people that are going to be looking back to 2022's returns and saying, hey, we moved higher by more than 100%. This year, net lower. So what do you expect the company to signal in terms of the tone and what the market environment is like?
Oh, I think it's going to be about buyback. The company has said that they've increased the authorization to $75 billion, which obviously is a huge amount of money. Now, that's over several years, but my expectation going into the meeting tomorrow is that they'll probably increase the buyback for this year to $20 billion, which really is how you drive these low growth companies higher and get cash back to shareholders as good returns.
Certainly. And within the broader energy space here, I mean, we're coming off of, we'd be remiss if we didn't mention, of course, Occidental Petroleum, one of their new favorite fans in Warren Buffett. And we're coming off of a big weekend for Buffett and the shareholder letter that really rocked some elements of the larger market when it comes to buybacks that you were talking about a moment ago here. So for Occidental, for the larger energy space here, can they expect the same type of fanfare that we had seen from Buffett in 2022 to remain persistent or even move forward and elevate even more from the levels we had seen last year?
Well, we'll see tonight because they're reporting after the market tonight. So it'll be interesting to see the numbers. And then, of course, we'll get the CapEx, the capital expenditure outlook for 2023. Our view is that Mr. Buffett wants Oxy to spend as little money as possible and get as much free cash flow as possible and more buyback. We also think Oxy is very interesting from the point of view of carbon capture. I don't think it's something that Mr. Buffett's particularly focused on, quite frankly, but we think there's $25 of value long-term in Oxy for its quite unique position and ability to capture carbon. That's a future project, but one that looks very exciting to us.
How would you qualify the international demand environment in the oil and gas landscape right now?
Well, obviously, we're very focused on China. China's been the big driver of high oil prices over the past 20 years. And the data is kind of mixed, actually. We're certainly seeing rapid growth in jet demand, and that's across Asia as well as globally, actually. But the Chinese internal picture is always a bit tricky because, you don't really have the great data. You're not sure what they're doing with inventory building and everything else. But generally speaking, we're expecting China to be strong this year. And most people are now expecting the second half of the year to be very powerful for oil prices. The problem with the oil stocks that you mentioned, Chevron, Oxy, and others, is they're more or less discounting the current price. Call it $75 WTI, $80 Brent. It's about what's discounted in the names. You really need to push higher towards 100 to get excited about these stocks. And most people that are doing balances of oil believe that we'll have that push towards 100 in the second half.
Okay, and so a lot of people at the end of this discussion just want to know whether or not they should be taking any type of position or setting any type of position, or if they should be holding off within this sector right now.
Well, the sector's basically paying you around 10%, which is a good yield when you combine, for example, Chevron's actual dividend plus the buyback. I think we had set a hurdle for 10% returns as to make the sector attractive, and we're more or less getting that from a name like Oxy. So we like them. We like the group. We do think oil will go higher over the course of summer. And so, yeah, we're bullish on the oils.
Sankey Research oil and gas equity research analyst Paul Sankey. I was reading your research note as well over the weekend, and it sounds like we might be Brooklyn neighbors. So I'll be looking out for you on the streets of New York City, specifically in the Brooklyn borough. Thanks so much.
Awesome. Yeah, it'd be great to hang out.
All right. See you soon. All right, guys, coming up on the other side, the AI train chugs along, everyone and their grandma. Yeah, looking to get into the ChatGPT game. It's made its way to the dinner conversation, and Tencent and Snapchat are the latest names reported to be having their own conversations, developing their own versions. We're going to dive into all of that next.
the compute intensity of AI is far greater than conventional computing. And so I think the revenue that's associated with AI will be directly proportional to the computing opportunity here we see long term.
This is the most innovative time in history, and there's a lot of opportunity and acceleration and innovation right now. And one of those areas is artificial intelligence. I think there's several ways to get exposure to artificial intelligence. One is hardware that you just spoke about, and chips, and so NVIDIA is the kind of the poster child for that, but there are other companies like Marvell and semi-cap equipment stocks that could also fit the bill.
These chip manufacturers are the ones that are making it really easy to be able to handle and power these AI systems. The picks and shovels makers in the AI space, much like in the crypto space, are the ones that you should hold on to because they're going to generate a big profit.
The buzz around AI building. As everyone tries to get a piece of the action, China's Tencent is reportedly establishing a team to develop a ChatGPT-like product. This as Snapchat is looking to release its own version. But in what direction does growth lie in the AI space? Here with all the details, we've got Yahoo Finance's Dan Howley. Dan, you've been tracking this closely, and a lot of people just want to know who's going to win out or if this is even really a zero-sum game.
Yeah, Brad, I don't think it's a zero-sum game. I also think that, there is a good amount of hype around AI right now. Some of it is earned, some of it not so much. So just, quickly, as far as the news goes, yes, Tencent is working on a ChatGPT-like offering, a kind of AI chatbot. Microsoft, obviously, they have their ChatGPT-powered Bing, thanks to their investment in OpenAI. And then we have Google working on Bard, as well as other companies dipping into the space. It feels, though, very much like what we saw at this point with things like Web3, the metaverse. I believe our own Julie Hyman had talked about this, that, there's definitely a trend going on, but also people latching on to AI in any way they can to just kind of say, look, we're associated with it. You should probably, invest in our company. And so, there's certainly that out there. I do think, though, that the ability that we're seeing with AI will improve companies' capabilities in different ways. That'll either be not necessarily with these kinds of chatbots, but it could be improving efficiencies, things like that. So, while these ChatGPT products are very interesting for sure, this isn't the only type of AI that's out there. And really, what it comes down to is, and some of the experts I spoke to is, yes, this is amazing the way it can generate this text and you can seemingly have a conversation with it. The reality, though, is that they're super powered versions of predictive text, from your phone. So when you type in a text message, and then it gives you the next word that you want to type in, and you're like, oh, wow, that's really cool. That's really what's going on here. So it's not as though this is going to change our universe, but it certainly is on the way to improving different types of the sectors of the economy, national security, anything that you can think of, not necessarily just ChatGPT, though.
All right, Yahoo Finance's own Dan Howley, thanks so much for really teeing up this next discussion here, Dan. U.com is entering the chat in the AI race. The young startup recently launched its next generation of UChat. It's ChatGPT-like search assistant. But how does it plan to go up against the big tech giants here? Well, here to discuss, we've got Richard Socher, who is the U.com founder and CEO. Richard, thanks for joining us here. So walk us through the ambition here to really add on or capitalize on top of what many who are looking to search engines and that next leg of growth or innovation, what they're looking to with AI.
Yeah, U.com is the best search chat engine. It gives you control over all of these latest AI features that you just mentioned, and also the content sources you might like. It's the best kinds of features combined of a chatbot like ChatGPT and a search engine like Google in a modern interface. So for example, as a marketer, it may generate a novel copyright-free image for you. As a programmer, it won't just give you a list of blue links, but it'll write an entire code for you. As a student, it may write an essay draft for you, depending on what you ask. So ultimately, I think search engines are going to be much more than search engines. We want to help you actually accomplish more.
Talk to us about the monetization. I mean, we layer on AI to search engines that typically made their money from advertising dollars. And so now, where does that monetization, where does that profitability model really come into play?
Yeah, we will also explore private ads that don't follow you around the internet everywhere and invade your privacy. We try to be a lot better on privacy, but 80% of the signal in a search engine you actually get from the query. If someone searches for air purifier, you can show them still a private ad for an air purifier. But we also want to help people actually do things. And when they actually use these AI apps, they can also just pay a subscription for these AI applications that are within the search engine.
Okay, and so for the number of users that you're anticipating to really engage with this, how does the model itself, because this is a language learning model essentially that we've heard from so many different generative AIs, how does your own model continue to improve with the number of users that are then engaging with it?
Yeah, it's a great question. We already have millions of users. We really had this sort of proverbial hockey stick starting in December when we launched UChat. And it's been incredible to see and also get feedback from users. They can vote on saying this answer was right or not right for them. That helped us to be much more factual. We now have multimodal responses. Also, where you can see, for instance, the stock price directly within the chat interface instead of the chat bot making up things. And I think these are all very important pieces of making this whole chat interface work for a search engine.
So what have the responses been from those users who have engaged thus far?
It's been extremely positive. Of course, there are always a few folks who find an answer that you don't like. And sometimes it's hard with these models. You might not know whether the user wants to create a new story and make something up, or if they really want to just ask for a specific fact. And we're pulling in more and more information now from Wikipedia and different content sources that you can control also, such as stock and weather apps and things like that. And so with the combination of these apps that we have in the search results page, the AI capabilities, and free form text that you can ask follow-up questions to, it's been very, very positive.
So let's be clear about the market that you're in right now, especially on the search engine front. You've got some behemoths, and it's unlikely to be able to outspend them because of the cash flow that they already have and where they can deploy that. But perhaps in the out-innovating some of those larger players that are in the search engine game here, how do you go about layering on different elements that users can expect to really round out the experience or make the experience for the users that much better?
Yeah, you have some very big tankers that are following our little speedboat here, especially since we've launched UChat. We've seen big players like Google and Microsoft trying to get into the space. You're exactly right. What we mostly want to focus on is out competing them on speed and getting the most exciting AI features into the search engine more quickly. And then hoping for a little bit of them also being stuck in an innovator's dilemma. You know, when you make $150 billion or more in advertisements, I don't think you're going to want to replace half of all those ads with a beautiful AI chatbot that just gives you the right answer and helps you accomplish more. You kind of want people to continue clicking on those ads. Otherwise, you probably lose a couple $100 million a day in revenue. And so that is an opportunity for us to move quickly and build new kinds of ways to interact with content and create and accomplish things online.
$20 million raised for U.com in 2021. 2022, you saw $25 million raised for the company and further expansion. Do you anticipate needing to raise additional capital this year?
Yeah, it's a good question. We definitely have a lot of interest from VCs reaching out. We're contemplating that. It is not cheap, and we had focused mostly on growth like most consumer companies have. We're now thinking also stronger and working on our monetization to get private advertisements going, to get subscription models going for the most cutting edge AI capabilities. Yeah, we'll see what this year holds. It'll be an exciting year for search. I don't think we've seen this much excitement about how different and better search can be for the last 10 years. And I can guarantee you in 3 to 6 months, most people will search very differently on the web than they did the last 20 years.
U.com's founder and CEO, Richard Socher, thank you so much for joining us here today. We appreciate it. Guys, coming up, adding to the confusion, a report from the Wall Street Journal suggests a U.S. agency is backing the Wuhan lab leak theory. We've got that story for you next.
So like most investors, Warren Buffett's diversified portfolio has consolidated over time. As of December 31st, 2022, Berkshire Hathaway's top 5 holdings made up about 75% of the company's entire portfolio value. Apple is Berkshire's top holding, accounting for about 40% of the company's portfolio. That's about 4 times the size of the next closest company, Bank of America, which accounts for just more than 11% of Berkshire's holdings. Up next is Chevron. The oil giant accounts for just shy of 10% of Berkshire's holdings, while Coca-Cola, one of Buffett's most famous investments, particularly given his insistence on always sipping that soft drink, represents 8.5% of the portfolio. And American Express, a longtime holding of Buffett, rounds out the top 5, accounting for 7.5% of Berkshire's holdings in this.
So I guess the question is, when the Oracle of Omaha bought these, how have they done? How have these stocks done since you've bought them?
Right. So let's take a look at Apple first. And you would think buying Apple in 2016 might have actually been late, right? I mean, the iPhone came out right around here, and you see a big jump there. But really, when you take a look at where they bought it in 2016, let me just get my pen going here. They bought it in 2016 here. And then it took a big jump after that. And then they've sort of benefited from Apple's growth in iPhone services and sort of the services and cloud as a whole. Then when you take a look at Bank of America, they bought Bank of America, if we pull up a 10-year chart, they bought Bank of America in the early part here, back actually in 2011. So they bought Bank of America down here. You can see the ride that Bank of America went on after that. So in some senses there, it was about buying Bank of America at the right price, basically buying almost the bottom of Bank of America, even lower than the great financial crisis. And then I want to round it out with Coca-Cola. This is a stock that Warren Buffett has owned for a long time. Going back to 1988, that's around the time that Powerade came out. Coca-Cola's Gatorade equivalent, right? And sort of you can see how they benefited from the long rise of Coke. When you take a look at a Coke Max chart, you can see that that stock all time is up over 4,000%. And you can really see the big jump here that happened after Berkshire bought in those early days. Because again, guys, it's about, for Warren Buffett, it's about holding on for a long time and benefiting from those product innovations. Coke Zero didn't even come out until about, I think it was 2005 or 2006. So think about how much that company's changed since '88. Over 30 years later, they're still along for the ride.
And there's a reason why he's known as such a legend, right? Thank you so much, Josh Schaefer.
The U.S. Department of Energy shifting its stance on the origins of COVID-19, with new classified reports talking about and attributing the cause to a lab leak in China. U.S. agencies remain divided on the origins of the virus. However, the Energy Department, meanwhile, says its judgment was made with, quote, low confidence, according to reports. Yahoo Finance's Anjali Khemlani is on the case and joins us now. Anjali, what do we know so far?
So what we know, Brad, is that the Wall Street Journal is reporting that the Energy Department updated its 2021 findings, leaning towards the lab leak theory. They joined the FBI, which previously reported having a moderate level of confidence in that same theory, and is just part of what is continuing to be the U.S. government investigating the origins of the COVID virus. We know that other institutions and agencies have been leaning towards the natural spread transmission, but no one has really had a definitive answer yet, and that's because we just don't know fully where it's coming from. But we did get some word from the National Security Advisor, Jake Sullivan, speaking to CNN on reports from this Wall Street Journal report, saying that he refused to confirm or deny it, but did say that all agencies that are part of the intelligence community are on the case.
Anjali, how does the Energy Department's latest revelations compare to what the rest of the U.S. government thinks?
Well, not just the U.S. government, but also internationally. Take a look at where the spread is right now. The World Health Organization did, we know, in 2021, try to assess the origins and looked into the Wuhan market in particular in coordination with China. That report, we know, got a lot of criticism but because they did say that they couldn't assess the Wuhan market's effect on the virus spread. But we do have 4 other unnamed intelligence agencies agencies as part of the intelligence community's report earlier on, as well as the NIH leaning towards that natural transmission, the FBI and Energy Department, like you know, leaning towards the lab leak theory, CIA, one of the departments that we know has not really decided either way. We know the CDC, we've heard directly from Dr. Rochelle Walensky saying that the lab leak theory could be a possibility, but typically these types of transmissions come from animals. And that has been sort of the stance of the scientific community. Anyone I talk to kind of says that they haven't necessarily fully thrown out the lab leak theory, but they do say that the likelihood of it is lower in comparison to animal transmission.
All right, Yahoo Finance's own healthcare reporter, Anjali Kamlani. Anjali, thank you so much for tracking this for us. We appreciate it. The president of Belarus set to visit China tomorrow in the hopes of helping China engineer a peace agreement between Russia and Ukraine. This even as Beijing continues to consider lethal arms sales to Russia. Here with the latest, we've got Yahoo Finance's Rick Newman. Rick, what do we know about this so far?
Well, China invited the Belarusian president Lukashenko to Beijing. He'll be there for 3 days this week. And it's not the most welcome development from Ukraine's perspective. There have been reports circulated by the United States that China may be considering giving military aid to Russia to help with its war. Think drones, for example, lethal drones. Lukashenko, the Belarusian president, close ally of Vladimir Putin, so he could be going as a Putin envoy to discuss possible aid to Russia to help them fight this war. Now, China is, in the last couple of weeks, has gotten more involved in this. They floated a so-called peace plan. They're trying to assert some influence here. Washington is not thrilled about this. The United States basically is saying China is not relevant to this conflict. We just want them to stay on the sidelines. But the most important thing to watch for here is whether China would begin to help Russia more than it is already doing. It has been buying Russian energy supplies, but not really providing any kind of material Russia could use in the war. If China were to do that, that would be a big move that would be real worrisome for markets, because the United States and Europe would probably respond to that with some kinds of sanctions on China. So important point to watch.
Rick, while we have you, Saudi Arabia has signed an agreement for Ukraine aid. Interesting move here. What is the latest there?
It is an interesting move. Now this is humanitarian aid. Saudi Arabia has said it's going to offer Ukraine $400 million of aid. That is not bombs and weapons. That is humanitarian aid. About 75% of that will be oil products. But this is an interesting twist, because Saudi Arabia, in ways, is an ally of Russia. They are both members of the OPEC Plus oil-producing cartel, and they communicate and they act in conjunction with each other to some extent with regard to oil production. So Saudi Arabia kind of demonstrating it wants to earn some points for being a good global citizen and helping out Ukraine. So Washington has said, hey, the more aid for Ukraine, the better, and they are happy with Saudi Arabia stepping up here.
All right, keeping tabs on all of this for us, Yahoo Finance's Rick Newman. Thanks, Rick.
See you, Brad.
See you. Coming up, taking a look at some trending tickers this morning as we are approaching the start of the lunch hour here in New York City. Everyone on the East Coast, stay tuned.
Warren Buffett's annual shareholder letter is out. Here are 3 top takeaways from the Yahoo Finance team. First up, a call to action to all humans: start saving money. Buffett says this: "It is those dedicated savers that are forefront in my mind as I write this letter." He adds, "Charlie and I are not stock pickers, we are business pickers, telling people to save money." And maybe they're listening. The U.S. savings rate is now at a 1-year high at about 4.7%. I think Buffett wants to see it even higher. Takeaway number 2, investing school is in no session. Again, no surprise here in the Warren Buffett annual shareholder letter. Buffett noting this, saying, quote, "The lesson for investors: the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders." And yes, it helps to start early and live into your 90s as well. Warren Buffett, 92 years old. His longtime partner, Charlie Munger, 99 years old. Warren Buffett saying, if you want to be a successful investor, invest for the long term. No surprise, that's typical Warren Buffett being Warren Buffett. Takeaway number 3 here, a message or messages to all politicians here. Warren Buffett taking some jabs at folks in DC, noting this: Berkshire also offers some modest protection from runaway inflation, but this attribute is far from perfect. Huge and entrenched fiscal deficits have consequences. Interesting take there from Buffett. Buffett also says, really tries to, I think, champion stock repurchases, saying repurchases, those that tell people that repurchases are harmful to shareholders or to the country are particularly beneficial to CEOs. You're listening to either an economic illiterate or a silver-tongued demagogue. So Warren Buffett taking some swings at politicians. What we did not hear in this letter, no succession plan. Warren Buffett and Charlie Munger will be at that May 5th to May 6th annual shareholder meeting in Omaha. Brian Salzi out.
Let's take a look at some of the trending tickers here just ahead of the noon hour, headlined by Zillow, as we've got them here and the trending tickers list pulled up on our Yahoo Finance Interactive, as well as zeroing in on some of these main trending tickers that we're tracking. Zillow is up by about 2.3% right now. JPM likes the company's position as the most visited real estate site. It sees solid margins and a, quote, healthy balance sheet, helping cushion it against continued macro headwinds. We also see Pfizer and biotech firm Seagen moving here on a Wall Street Journal report that a deal between the companies could be in the works and worth more than $30 billion potentially there, which is essentially the market cap of Seagen right now. So once you slap the premium on top, it would likely take it north of that $30 billion market cap. And then additionally here, Union Pacific trending as CEO Lance Fritz plans to step down later this year. Some activist pressure certainly weighing on that decision. But then additionally here, as we were taking a look at the Yahoo Finance Interactive just a moment ago, I also saw one company, Fisker, actually leading some of the move in our trending tickers here on the day. It's up 30% here. You're taking a look at the past 5 days, but that intraday chart here, yeah, wild to the upside there. And here's why. The company had just reported some of their fourth quarter 2022 results. And one of the things that they did call out, the results reinforced their expectation that at the time of launch, Fisker Ocean will have the longest range of any SUV, crossover price below $70,000 there. So some interesting product insights and announcements there. And Fisker certainly getting a bite here from the Wall Street community. We're seeing that up by about 30%. And just lastly here, taking a look at some of the major averages here as we ride out on this, the 11 a.m. hour. The Dow, the S&P 500, and the Nasdaq, they're all in positive territory there. You're seeing them hold on to fractional gains across the board, led by the Nasdaq on a percentage basis, up by about 0.8%. The Dow Jones Industrial Average up 0.25%, S&P 500 up by about 0.5% here. And that's going to do it for now, folks. I'm Brad Smith, in for Rochelle Akufo today. And that right there is your 11 a.m. hour. Stay tuned. We've got much more Yahoo Finance. We'll lead you to the closing bell at 3 p.m.
Bye.